Hey, what's going on? Strat Soldier here for the weekend shift. I got something awesome for you today. I know we did Options Mike last week, and you're like, it's another recording. But this is good, all right? Options Mike last week was good, okay? All right. And then Love K a couple weeks before. That was good. And then we're gonna continue with the goodness, all right? And just like the strat, we create a winning position and then we keep adding to it. Keep adding to it. I got Car Dave here, all right, from Empowerment Assets. And you know him. You know him because he's the one that does our news. And I'd let this is awesome that we're here because this has been maybe a year. Yeah, I think a whole year in the making. Once he comes on, we'll talk more about it. But this has been a whole year in the making because he got a hold of me last December and was like, I like the strat. I like what you're doing. I like your show, but you don't do nothing with the news. And I was like, no, the strat don't trade the news. And he was like, come on, man. And I'm like, who is this? I'm not, I don't think I'm, first of all, I want to say, I don't think I'm some high and mighty person or nothing like that. But I'm like, man, I'm, I'm trading the strat. I don't trade no dang news. But I was like, you come up with a news clip, prove it to me. And I love working with people that do what they say they're going to do. And I do that for myself too. So it's a little discipline thing for myself. I say all that to say he proved it to me, showed us the news, and we've been making some really good trades on the news he's been putting out, and it's been awesome. And I'm so glad he's here. And today he's going to show us how to trade options. So, Car Dave, if you can hear me, go ahead and turn on your camera. Let's get this thing going.
Welcome, 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 welcome. How you doing today? Thank you for having me.
Yeah, yeah, I'm glad you're here.
Yes.
Like I said, it's been a year in the making, and I always say I follow people for a long time before I got to watch them, and so I've been watching you for a long time, even before we started talking about the news, even before so this has been a long time in the making, and this is awesome. I'm glad you're here.
I'm glad to be here, man. I'm glad to be here. Show the people something that's very important. I know over time everybody is teaching options, but I'm gonna show people how I trade options my way and how I actually bridge the gap between the news. So I like to use technical analysis and fundamental analysis, and I like to tie them all into a knot and then see how I can actually use them both in conjunction. So you ready to
Awesome.
rock and roll?
Oh yeah, if we're getting into it, yeah, yeah, okay, all right, let's do it. He said no messing around.
Let's get it.
Empowerment assets, not slow down and wait assets.
Right. That's what it's about. That's what it's about. So you should be able to see my presentation on the screen, right?
Yes, looks good. Looks good.
So let's get to it. So Empowerment Assets Complete Options course, ladies and gentlemen, you guys are in for a treat. Strat Soldier, ladies and gentlemen, make sure you guys tune in every weekend. Let's get to it. First thing first, I just want to thank everybody in all our armed forces, the Air Force, the Navy, the Army, Space Force, the Marines, the Coast Guard. Without these, ladies and gentlemen, we won't be able to have the freedom that we have to be able to continue to keep on living. So I want to thank everybody that served in the past and everybody that's serving in the present. All right. First thing first, when it comes to options, ladies and gentlemen, I want you guys to understand that options isn't a contract, it's an agreement between a buyer and a seller. So you have somebody that's purchasing something, you have somebody that's willing to sell it. So in options world, we all focus on puts and calls. That's the meat and potatoes of options. So we understand that calls is bullish. We understand that puts is bearish, but each option contract is worth 100 shares. So when we guys say, hey, I'm buying 10 option contracts, you're actually holding 1,000 shares. So that's how options actually works, ladies and gentlemen. So when you guys are on the bullish end or the bearish end, we're looking to be profitable. So we're going to get into that in more details. We're going to explain that throughout the PowerPoint. So first thing first, why do we trade options? It's leverage. Everybody is looking to turn a little bit into a lot. So we control 100 shares, which much smaller cost. So example, let's say if you was buying 100 shares of Apple and you wanted to buy it at $100 each, you would pay 10,000. But let's say you want to buy a 10 option contract or 100 contracts for $5, $10, you'll pay less. So this is why we trade option because we can actually leverage a little bit more. We can pay a little bit less. So it defines our risk. You can only lose what you invest. I know a lot of people have these questions. Can I lose my whole account in option trading? If you put it up, you can. But if you only put up $100 on an option trade, you only can lose $100 or whatever your risk desire is. Now, you want to also pay close attention is high reward potential and it's flexible. It's very flexible. You can profit on the upside, you can profit on the downside, and you can also profit in a sideways market by using multiple strategies. Let's get into it. So
Man,
first thing first,
hold on, wait, wait. We are in the wait. I know when we're trading, people like to talk about Lambos and Ferraris and things like that, but for real, we are in a Lambo and you ain't giving us no time to take no notes or nothing, man. You just like all in fifth gear, go.
yeah.
We like
Lamborghini, Ferrari.
one thing I want to say, right before you get into fundamentals, I love that I already know we're in for a treat because I had to jump in there to the like, hold on. Um, what I just want to emphasize that I love the fact that you said with options you can only lose what you put in. So if it's $100 contract, you can only lose 100. Now with the strat, I'm going to say just the with that strat. Remember, with guys, I don't want you and Car Dave does not want you blowing up your account or putting up 20 contracts to try and make X. All right. Yes, we do want to get to those profits. Carday is going to talk more about that. But just because, well, you can only lose 100 on this contract doesn't mean you can go ahead and buy five. Well, I can only lose 500. Like, think about that. Think about that in your head. Like, you're willing to risk losing $500 every time you. I mean, I'm kind of exaggerating here to get it in your guys' head. Like, if you're consistently losing $200 every time you do this, it adds up. Okay, if you're consistently losing $500 every time you do this, it adds up. So that's
That
all I
goes
want to say, and I'm glad you said what you said. That's all.
And that boils down to like risk management, risk
Yes.
appetite. So it's like a new beginner trader should not risk $500 if their account is 500 or $1,000. So it
Yep.
boils down to risk appetite. Now,
Okay.
let's talk about things that's very important to options trading, and I have to actually explain this to multiple traders on a daily basis. We have to be able to compare fundamentals and technical analysis. All right, fundamental is understanding what's going on in a company. What is their cash balance? What is the revenue that's coming into a company, right? So this will actually give you a solid blueprint of the company if the company is performing well, if the company is not performing well. So you can use that to your advantage as a trader, and it will show up in a technical analysis, right? So this
Yes.
goes back to my key point. News moves the candle, candles doesn't move the news. So when it comes to using fundamentals and technical analysis, you want to understand fundamentals. How have this company been performing over the last month, the last quarter, the last 2 quarters, the last 3 quarters, the last 4 quarters? Now we can actually assess that with the technical analysis. You can use the strat, you could do ICT, you could do support resistance, supply demand, you can do smart money concept. You can use all of these things, but it boils down to fundamentals and tying in the technical analysis, right? So you want to be able to define fundamentals by having a bias, right? Are we bullish? Are we bearish? Are we consolidating? How long have we been consolidating? The counterstick would actually show you that. So we want to be able to understand. You got to know what you're using. If you're using indicators, multiple time frames, you want to keep your eyes on the volume. You want to make sure that you understand the fundamentals to this company. Stick to your plan. My whole thing is don't change your plan because you're on social media. Don't change your plans because it's a big time trader that made 30,000, 50,000. Understand the fundamentals and technicals, and you can actually proceed to move forward.
I
Let's
love
get
it. I love it. I love it. Don't trade to impress other people. There's a meme going on out there, and it's funny. But don't take that. I would rather you. Okay, here we go. I'd rather you push your stops up and then take a screenshot of what's going on and say, "Oh, hey, this is what's going on. It's working, Car Dave. It's working, Strat. So whatever it is, whoever your favorite person is, it's working." Move those stops up before you take that screenshot. Everybody likes to. I want you to be happy that you're winning. I want you to be happy that you're gaining that, making those gains. But don't take that screenshot and then let this thing go into the dirt.
Right, because if you take a screenshot, like I always try to explain to traders, is let the fundamentals pick the play, right? But
Mm,
once you get to a point, if you don't allow the fundamentals to pick your play, technical knowledge is not going to work, right? I don't care how
mm.
good you are at charting. Fundamentals have to pick the trade because you got to understand if the company is performing well or bad, right? So that's like Nvidia had earnings a couple of weeks back. The fundamentals gave people an opportunity to pick their what? Their play. If it was going to be
Mm.
puts or calls. And initially we did push up in the after hour, but when the market opened in the morning, we flushed down and the market dropped. So that was some form of a fundamental. Fundamentals pick the play both ways, right?
Okay.
Technical analysis was good, but forward guidance wasn't too great. So those are all based off of fundamentals. The second thing, you want to be able to look at time and structure. So when
Time
you're
structure.
trading the market, time and structure. So
Oh, okay,
basically,
okay.
you want to know how a company is performing over a given period of time. It can be the first quarter, the second quarter, the third quarter, fourth quarter. Do they drop in the fourth quarter? Why is that? Is it because of holiday season? Is it because the sales are bad? Now, third step, you want to acquire confirmation for both, right? You want to understand the fundamentals and technical analysis lines up. And once these two lines up, you got a match made, right? Let's get it.
Yeah, I like that because we talked about that. I was on TrendSpider today, and we were looking at seasonality of Ulta, and they just do makeup. You think makeup is why are there seasonality on makeup? But if you look at their seasonality, their third quarter is a big old red bar for years back, and it actually states in some of their we ran a sidekick on TrendSpider, and they gave us a lot of data. Anyway, turns out that Ulta does not put a lot of their product out there during the third quarter. They hoard it all for the fourth quarter for Christmas and everything like that. For the fourth quarter, then they put it all out. So what you're saying about the fundamentals and the time and structure, I like that. Just so a good example is Ulta. You know what I mean? It's not a good time to buy Ulta in the third quarter when the company like strategy is to hoard the product for the fourth quarter. Very good. I like that a lot. I
They're
like that a
just
lot.
like Black Friday, right? It's like
Hmm.
everybody put all their over bulk items, right? Items that wasn't selling all year long. They put it on sale for Black Friday because
Yeah.
it's a form of seasonality. They know shoppers is shopping for Christmas. They know they're shopping for New Year. So quarter and timing is everything. All right.
Yeah.
Now, this is what I try to explain to people. Every option have two key points, right? So key two parts, right? So you're picking a strike and expiration date. So when you're picking a strike price, we like to use something that's called average true range. So this is the true range that a stock can move to the upside or to the downside in a given day. So you'll see SPX have a true range of $70. That means you can go $70 out of the money, right? But I always try to tell people split it up in fourths, right? One fourth. So if it's $75, you split it in half. So pretty much it can move 20, or we can move $35, right? So you want to be able to pick a strike price 35 out, $20 out. Depends on your risk appetite. It depends on your account size, right? Anybody
Okay.
can trade SPX. It depends on what you're willing to invest. Next thing is expiration date. This is important. I want you guys to remember me telling you this. I would rather have the time and not need it and need the time and not have it. Always
Okay.
remember that it's okay to buy extra day. It's okay to buy extra week. It's okay to buy extra month because I would rather have the time on my side than have the time going against me. How many times have you got into an option contract and you came to realization if you held it for one day or you had an extra day or extra week, you would have made 200, 300, 400, and 500% profit. So that boils down to strike price and expiration date. And every option contract expires. We know that no matter if it's 1 year out, 2 years out, every option contract expires.
Yes, and I like that. And you'll have let's just say a higher. I like the higher probability of the trade working if you bought 2 weeks as opposed to 1 week. Maybe this is a straight. Maybe this is a trade just for this week, but me personally, I like buying that 2 weeks out, and that way, like you said, I got that time because your homeboy Theta is definitely gonna let you know you can't hold that thing. I'm sure you're gonna talk about that later on.
Nate is a hater.
Theta is a hater. Oh, I like that.
So, as an options trader, right, I try to explain to people if we're trading options, right, options derive from something that's called a derivative. And a lot of people they fail to realize this is just a fancy word for a financial product, right? So either the derivative is going to go up, derivative is going to go down. So us as options trader, no matter if you're trading the Strat or ICT, we're either trading stocks, individual, Coca-Cola, Pepsi, Apple, Nike. These are individual companies, or we can trade ETF like JETS. This is the airlines. They got American Airlines, they got Southwest, they got multiple other airlines under this ETF. So it's an umbrella and a basket of stocks. Now, either we can trade bonds, 10 years, 30 years, 3 years. We can trade those as well. We can trade commodities, right? So the number one commodity in the world is oil. Oil
Mhm.
is a byproduct of so many different things. They use products for toothpaste. They use product for rubber tire. So we need to understand what commodities move the market. Oil, gold, silver, coffee beans, coin. So we can actually trade options on all of these, or we can trade futures, right? So that's just another thing that's outside of options. Currency, interest rate, and market indices is very important. We can trade SPX, NDX, and one that's not talked about a lot, which I've been trading for years, is RUT, RUT. Right?
What is
RUT
RUT?
is an
RUT?
So is a small cap. So it pairs with IWM, is the
Oh,
Russell. You can trade that as an indice, right? Just like
okay.
QQQ,
Mm-hmm.
NDX, you can actually pair those together.
Mm-hmm.
ES, you can pair that with SPX SPY and XSP. So you can actually trade these. This is another indice that you can trade on in any given day and be profitable.
Okay.
Right? So
Yeah, I'm looking
that's
at that now. I'm looking at that rut. Interesting.
yeah, very
Man,
interesting. And it moves.
man, I like learning, but I didn't think I was gonna learn all that. Hold on. I'm
I
supposed
like
to
it. I like it. I like it. I
I
like it.
love
So
it. I love it.
that's what a derivative is. I try to explain to people when you're trading options, you need to know the keywords of derivatives. And these are the products that we trade on a daily basis as options traded. And also if we trade shares. So that's another way to make money as well.
Okay.
All right, let's get into the meat and potatoes. I'm explaining to you guys what calls are. All right. So now in a perfect world. Call contracts is we're bullish on an individual stock or ETF or indice. We're going to make money as the stock goes up to the upside. So that's what a call option is. We say, you know what? I did my technical analysis. I did my fundamental assessment. That's my due diligence. So I say, I got a 3-1 setup. I got a 2-2 continuation in the strat world. I'm going to trade calls to the upside, right? And this is how calls work. You actually are being profitable as the prices increase, right? But if the price goes against you, you're losing money. So let's talk about this. A lot of people fail to realize you can trade call option multiple ways, right? So I give you an example. All right, so if you buy a $50 call, you're looking for this strike price to continue to keep increasing to 50 or above 50 so you can be profitable. So at a later date down the slide, I'm gonna tell you how you make money for something that's called Greeks. So I believe that the stock is going to increase, and as the stock goes up, I'm producing profit. If the stock goes against me, I'm losing money. Now, you can actually sell these option contracts and take profit, or you can do something that's called exercise, and we can talk about that at a later date. You can take the shares away. So that's just another way that you can trade option contracts and you can be profitable and you can become very wealthy at that. Now, if you guys really want to listen to this for a second, I'm going to explain something to you. Let's say you are trading an option contract and you want to exercise and take the shares away. You're taking the shares away from the what? The seller.
Mm-hmm.
All right, you're going to be paying a fee. So if you agree to take, hey, the strike price is $50 and you hit $55, the seller agreed for you to actually buy those shares at $50. So you'll pay 100 times 50. Guess how much money you'll pay for the shares? You see how that works?
Yeah,
And then
yeah,
the
yeah.
$5 in profit, you keep that on the share that you actually acquired. That's how
Wow.
exercising shares work. So
Okay.
in a different world, you can actually make money from exercising shares as well. So let's get into this. If I'm trading options, I can trade zero DTEs. So we understand what zero DTEs are, is 0 day to expiration. These are contracts that's going to expire today. In a real world, we want to be able to be profitable fast on zero DTEs. We want to be able to understand the direction, right? We want to understand if the trend is going in our direction. So calls expires today, right? Or we want to be able to trade intraday, right? So these are pretty much day trading, right? So you're looking to be profitable from 9:30 and before 4 p.m. You're looking to make money pretty fast. If you can make money fast, exit the position. Now, one of my favorite is something that's called swing trades, right? If you're holding a position for 1 day or longer, right? This is called a swing trade. You're looking to hold this position for a long day or longer. Now, one of my favorite as well is leap contracts. So you're holding a contract from 12 months, 3 years. Not all stocks, not all ETF offer leap contracts. So if you can find a Meg 7, you can find a Fortune 500 company that offer 1 year, 2 years, and 3 years. So one of my favorites right now is MSTR. Right. We understand
Yep.
MSTR mirrors Bitcoin. We understand that MicroStrategy is a beautiful company. So
Mm-hmm.
MicroStrategy is pretty much just dropped. So this gives you an opportunity to buy a leap contract out 12 months, 24 months, or 36 months. You can be profitable. But when you're trading in leaps, that means you believe in the company.
Yeah, because I'm looking at this thing. You got to believe in something, boy. If you MSTR said, if you got to believe in something, why not believe in me? Because this thing, all the way down from 400, 412, all the way down to 186. And this guy is in the news right now because he did he bought a lot of Bitcoin, a lot of Bitcoin. Just for example, for these leaps, I like what you're. Do these leaps usually cost a lot because it is 2 years out? Is the premium crazy?
So, as a real trader, right? So
Okay.
I don't really try to put price on contracts. I'm putting price on a company. So
Okay.
I'm willing to pay a certain amount because I know this company is a beautiful company, have beautiful fundamentals, right? And the technicals look good. So if you can put $1,000, $3,000 on zero DTEs, you can put $1,000 and $3,000 on leap contracts. Now, you won't make your money fast enough, right? But I'm gonna give you an example. Let's say
Hmm.
you put $10,000 on a leap and you got a 2 year. Let's say in 2 years at $10,000, you make 10%. Let's say you make 1,000%. In this instance, if you made 1,000%, you made 100,000. But let's say the contracts that you bought was 200 strike price and you bought them at 100 and it went to 500. You can actually exercise those shares and take the shares away and be more profitable by holding the shares. So leap
Ah.
contracts can really work in your favor if you just take your time, but it's only on quality companies, right? So me personally, the last time I did a leap was on something like Coca-Cola, because I really wanted to take the shares away to be able to keep the dividends. Now
Yeah.
I'm getting paid from the dividend. So those are things that I look forward to when I'm doing leaps. You can do leaps on SPY. We in the 700 calls on SPY. We in $800 calls on SPY. We took them out. We understand that SPY has a ceiling of $1,000 over the next 36, 48, 60 months. So why not get into leap contracts 2 and 3 years out and allow it to keep on growing?
I'm not laughing. I'm not laughing. I'm not laughing at you. I'm sorry. It's the I'm impressed. You have your strategy. I'm telling you, you have several different strategies, and I'm getting excited. I'm getting excited about that. So I apologize for laughing halfway through that. It wasn't because of unbelief. It was because I am impressed. So I apologize. That was untimely.
Let's get it. Let's get it. So on the opposite side of call, we got something in the market that's called puts is bearish, right? So you thinking
Mhm.
that it's going to be bearish on a 15-minute time frame, a 6 hour time frame, a daily time frame, a weekly time frame, or you feel like it's just going to be bearish overall, right? So now the way bearish contracts works, you say, you know what? I'm gonna put a put in. I think this ticker is going to go to the downside and I benefit as it declines. And as it declines, you are able to be profitable. It works the same way as call. Zero DTEs, intraday, which is same day contracts, swings or leaps. Now, another way that you can actually use bearish puts is you can use it as a hedge on your long-term portfolio. So if your long-term portfolio is declining, you just go and put puts in it against it, and you take the proceeds from the puts and you buy more shares if you believe in the company. So that's what we call a hedging position. So it was pretty much puts and calls was created as a hedging opportunity in the market, especially puts, because the big timers, the hedge funds, and the institutions wanted to find a way to be able to be profitable as the market declines. So that's what
Mhm.
puts is all about. So you're looking to be able to hedge your position, especially long term. So if let's say you're holding 1,000 shares of Apple, and Apple drops $3 in one day, and let's say your 1,000 shares lose 50,000.
Mhm.
Why would you
Mhm.
not hedge that while your long term is going down and be profitable on the put side? Take the proceeds from the puts and buy more shares. And as
Mm.
Apple goes back to its original volume, you didn't double your investment.
Wow. Yeah.
That's how you actually do it in the market. You just want to be patient and you just want to be poised. All right. So that's puts and calls. And I'm gonna get into a few strategy that I think a lot of people fail to realize that actually benefit us as a trader. Let's get to it.
Well, wait before you move the slide. I like this thing what you're saying down here, and I think this really sums up this really sums up things because you says down here it says you believe in the business, not just the trade. Now, see, in I don't want to overemphasize it, but the reason why I laughed is because I'm like, for example, MSTR. Like, why would I buy a leap on this? Because I'm looking at the trade. I'm looking at the price action. I'm looking for buys and sells. You are looking at the fundamentals and going, okay, I believe in this business because of X, Y, and Z. And I think that's the difference between, it's a good difference between me and you. And hopefully, you're through this conversation and through what you show me, definitely close that gap because I'm definitely starting to see the importance of looking at because I usually what's this company do? Oh, they make two-handle coffee cups. I'm like,
Right.
oh, okay, all right, 212 back up on the month, take it.
Right.
And you're like, you on your side, you're like, why would I? No, I'm not putting my money in this. But then we
Right.
look at something like ASTS, Space Mobile. We were talking about that. Space
Right.
Mobile was something that was $2. And I remember, I think it was Dividend Dog or another guy out there, but but me and you did start this conversation. We were like, why would I get in on this? It's Space Mobile. Like I made jokes about it. Like this is a penny stock. When I'm calling grandma from space, like no drop calls from space. I get it, but it went from $2 to I don't know what it is right now, but I mean above 25. And
Right.
you were in that ASTS. Let's just because we're in here, let's see what it really is right now. It's up to $72. $72, and I left the line on my monthly chart because you and others were talking about it at $2.95. And
Yeah.
again, that's where
It
just
was
based
based
on
off believing in the business, and also I trade with common sense,
mhm.
right? Because
That
I
and
know
yeah.
we advancing as a society, right? So to
hmm
think about it like this, we consistently keep on traveling to space. How are we going to be able to communicate?
hmm Yeah, and that's again, I think that's a real huge distinction. Just that one little quote, you believe in the business, not just the trade. That's interesting. I like that. I like that because people, use options in different ways. Some people use it to hedge, and then it seems like you do use the hedge, but it sounds like you're using it a lot to speculate. Is that true?
Right. And a
Okay.
logics, right? And
Yeah,
like
of course,
with
logic.
MSTR, I really like it, right?
hmm
Because if we just use logic and common sense, the way
hmm
society is operating right now is based off is digital, right?
hmm
So Bitcoin is a digital currency, XRP is a digital currency, MSTR is saying, hey, I'm putting all my eggs in one basket. Right. And my
hmm
basket is Bitcoin. So I have to have common sense as we continue to keep on growing as a society and as a world as a whole. Cryptocurrency is going to take over the world. And who's going to have the most cryptocurrency? MSTR. So that's going to bring the volume of MSTR up to what? 4, 5, 6, 7, 10x of what it's currently at right now. And that means Bitcoin is going to do 4, 5, 6, 7, and 10x from where it's right now. So the
hmm
digital asset world is going to continue to keep on growing. So why not invest in MSTR at this level? If you loved it at 400, you should be in love with it at 180.
I hear that. I hear that sometimes with other things. And again, I'm looking at time frame continuity. I'm looking at broadening formations. I'm looking at actionable signals. And you are again looking behind the scenes. It's kind of like pulling in a kind of pulling the curtain behind the Wizard of Oz and seeing what's really back there. Is this for real or is this? So I really like that. So I did not to slow you down, but I think. That one quote down there that really caught my eye, and I think that really
Believe in
sums
a
things
business,
up.
right? So think about this. You believe in yourself, right?
Yeah,
So if you
yeah,
believe in yourself, right, you understand that every day that you wake up, you're going to do everything in the best of your power to continue to keep on growing. So
mm-hmm.
if MSTR believes in Bitcoin, they're going to consistently keep on investing in what?
Yeah,
Bitcoin.
yeah, Bitcoin, definitely. Yeah, they invest in a whole bunch into Bitcoin. There is almost let me get this thing. It's a little fuzzy here, but yeah, they're invested in Bitcoin. That's it. That's it. Go ahead.
So
Straddle. Okay.
now let's talk about a straddle. So a lot of people they shy away from it, right? They say, "Oh, I don't play straddles," but a lot of traders online they trade straddles. They just don't show they losing position. Now,
Mm,
a straddle is a neutral position. You're doing put and call simultaneously, right? You're
mm,
buying all these contracts are at the money. So what do that mean? If Apple is $100, you buy
mm-hmm,
$100 calls and $100 puts. In order for you to benefit from a straddle, let's say you pay 200 for the put and 300 for the call. Your $500 total in on your premium, you need to make over $500 to be profitable.
mm-hmm,
That's
mm-hmm,
how a straddle is. Now, the reason you use a straddle is, let's say, like a earnings play, right? Or you say, you know what, my technical analysis lines up, but I still want to buy some form of a protection. So a straddle will come into handy. You still can lose on a straddle if a stock actually goes sideways and consolidates. So in the strat world, that means it's an indecision. That means it's a one candle. So if it consolidate, you don't make no money. You lose both premium. All right.
mm-hmm.
Now, it's two strategies that I want to talk about. I don't know if you ever heard about these, but it's called a strat.
Okay.
So let's talk about this. Now, an instant, a strap is a bullish volatility play, right? So in this instant, you're bullish, but you're buying two calls and one put. You're buying some form of protection. A lot of traders is using this, but they don't know the name behind it. So you pretty much say, you know what, I'm 66% bullish and I'm 33% bearish. All contracts are bought at the money. And the reason that you buy this is because you buy some form of protection, but you're feeling more bullish to the upside. So if it rips to the upside, you're not worrying about the put to the downside,
Mm-hmm.
right?
Okay.
So
Are you actually now you're saying buying? Well, I guess that answers my question. I was going to say a lot of these strategies I see that are alternate strategies, they say buy two calls, sell a put. That's not what you're saying here.
You actually buy two calls and you buy one put, right?
Okay.
Because you
Okay.
say, you know what? If it does goes against me, I have a put because if it's very volatile, my puts will outweigh my two calls.
Hmm.
right? So let's say you pay $100 for both calls, which is 200 on the premium to the call side and $100 for the put. Let's say we pretty have an earnings period, and let's say the stock drops 80 bucks, and let's say that $100 put turns into 3 grand because of
Yeah, yeah,
volatility. So now it
yeah.
was worth it. But if you would have just bought two calls, right, you was bullish, you would have lost $200 on the play. So you want to be able to always have some form of protection.
I like it. I
Yeah,
like it.
that
I'm sorry, I
works.
didn't want to cut you off. I was just saying, ooh, that's good. I like it.
So just some form of protection is called a strap, and all the contracts are at the money. You can be profitable both ways. Now, it's been an instance where I've been profitable on the calls and the puts. When I had a stock open up and I was able to be profitable on the calls, and have you noticed over the last couple of weeks we've been very volatile. So the calls printed and then the puts printed to the downside because we completely flipped.
That sounds like a scenario three situation. They bought it up and they sold it down.
Yeah, yeah. So you can actually be profitable, but as an options trader and also as an investor, your best thing is to actually buy some form of protection,
Okay.
because
I
you're
like
protecting
this.
your capital at all times, right? And I
Yeah.
know that we all want to be biased. I know that the charts is telling us one way, the chart's telling us this way. But if I feel real comfortable just with calls, I will do trade calls. And if I'm wrong, I'm wrong. And if I feel real comfortable puts, I just trade puts. If I'm wrong, I'm wrong.
Here's a question. Okay, so like for example, I put out daily watch lists, okay? And for my Strat Warriors and my weekend shift crew, let's say we got a hammer. Like for example, I think it was Amazon had a hammer on the day. And that did not go in force at all. It went straight to the lows, all right? 2-2 continuation down. So, is that a situation where I could have bought a call, let's just say two calls and then a put
Right.
protection, like you're saying. Is that something where I make money on the puts, but then it covers what I lost on the calls, and then it,
Right, because it's very volatile. So let's
yeah.
say on the calls you pay 200 each. That's 400, right? And you pay, let's say 300 for the put, you're $700 in, right? So
Mm,
let's say Amazon drops $7 and then let's say your put made 300%. It covers your calls and you still walk away with profit.
nice. I
You
think
see
that's
how that
where,
works?
yeah, I like that.
Yeah.
Wow.
And
Huh.
it works daily. But some things, like I said, when I see a hammer, I know there's a bullish indication, but I always try to explain to people if I see a hammer, especially if it's a bullish hammer, it's green. I'm always looking to see how far the wick extended down. Did it extend back down to support?
Mm,
Right?
mm-hmm,
If that is letting me know, hey, I know that the banks came in and extended, but this is a level I need to watch.
mm-hmm.
Right? Because
That's
why did we
smart.
bounce off this level? Why did they come back in and buy? So a hammer is telling you multiple stories, right? It's just not like calls. You want to understand, what did the wick bounce off of? What was their target? It can bounce off a fib level. It can bounce off many scenarios. So that's why I like trading the strap, and then I also like trading the strip. Is the inverse of the strap. So this is two puts and one calls. So you say, you
Okay.
know what, I'm feeling a little bit more bearish this time, right? So that's just like today, let's say you say, I feel bearish, right, on IWM, but IWM completely went up to the upside. So guess
Mm-hmm.
what? You got flushed out, right? But you still had a what? A call.
Call.
Let's
Yeah.
say a call went up $4 or $5, you still was able to be profitable. So you
Okay.
just buy some form of protection. So that's what a strap and a strip is. You buy some form of protection. All contracts are at the money. It's going to be a little bit expensive, but not like on ETF or IWM. The contracts is pretty much a fair price.
Okay, yeah, that was my next question going to be. Is it expensive? Uh, okay, good. I like that.
It's fair
Strat
price. So
and strip.
IWM pretty much at the money contracts, if they're not juicing the contracts, anywhere between 200 to $60. So you can pretty much afford both angles, right? And
Yeah.
on any given days, you can make money both ways if you just be patient and you buy in at the right time. So just like today, we completely went up to the upside, and pretty much around like towards the end of the day or a little bit before that, we flushed like a
Yeah.
dollar. So you was
Yeah.
able to be profitable both ways, right? And that's why I'll be sending you pictures like, hey, I scalped it. I hit it.
Yeah, he does. Hey, yeah, he does. He sends me all kind of like, dude, I'm at work. Let me see it. Yeah. And I feel like a dummy. You know what it is? I feel like a dummy because I'm at work like a clown, and he's over here in Cardave here making money.
So,
This is
now
fantastic. I
I
love it.
try to I try to break things down to people so they can have a common understanding on what we're trading, right? So if
Mhm.
you are scalping, you're sprinting. You're doing a 100 meter, the 200 meter, the 400 meters, right? You're a sprinter, 1200 meter, 800 meter, or even the 1K.
That's you. That's you. I'm telling you. Hey, when I say I said that whole thing about work, but he's like the market opened at 9:30. He's like 9:45. I did this. I did this. I did this. I'm like, what's happening?
In and out, right? So scalping is quick, explosive over seconds, maybe minutes. Day trading is pace, focus, enduring for short bursts of momentum. So that's pretty much like the 5Ks, the 10Ks, and then
Yeah,
we pretty much get into swing trading is like the half a marathon, the full marathon. And I try to explain to people, whatever your race is, run your race, right? If
yeah.
you not qualified or feel comfortable trading zero DTEs or scalping, go to day trading. Go to swing trade. Now, this is what I like the most. When it's leaps and long term, this is pretty much we're playing golf, right?
I
You pretty
like
much
that.
just allowing the contracts to actually bake, you allow them to cook over a period of time. So
Yeah,
leaps and long term investment is basically like playing golf.
I like
That's
it.
all
That's a
it
good.
is.
That's a good analogy. I like all this. That's a real good
But it's
analogy.
just patience, right? So I try
Mhm.
to tell all traders, you just want to practice the triple P's, being patient, positive, and persistent. Because if you don't have
Wow.
any patience and you're not positive, you're not going to win in the trade. And you have to be persistent because every trader breaks their hurdle. Maybe be 3 months, maybe be 6 months, maybe be 5 years. Everybody have their line where they actually break that threshold and become profitable.
Yeah, and in that threshold where it just clicks, like and this definitely could help me with the options. I traded an option on VXX because I know that that traditionally goes to the down. I mean, that's made to go to the downside, and I made that was good on that one. This is good, but again, you hear me all the time. These are my machine guns. That's my options trade. My cannon is these stocks. So what I'm saying is it took a while. It took a long time for me to just understand that's me. And like you said, that's my race. And sometimes it does take time to just learn, okay, maybe I'm not the fastest. Let me slow down. Hold on. Maybe I'm a no, I'm a okay, I'm a half marathoner. I'm a tank. Let me stay in this. It's gonna take a while, but I'm gonna be in here,
Right. You
and
just stay in your lane, play what works for
Mhm.
you, because over
Yeah,
time, once you find your system that works for you, now you can compound the contracts. You can go from
yeah.
one contract to 10, 10 to 100, 100 to 200, right? So I try to explain to people, once you start moving up with multiple contracts, you stay in the trade a little bit what?
Longer, yeah.
Less,
Hmm.
right?
Oh, less. I'm sorry, sorry.
Less,
Yeah.
right? Because
Mhm.
like you don't need that much of a big movement, right?
Oh, yeah, yeah.
So you can actually take a 3 month contract. You can get out in a month and a half. You can get out in 2 weeks. You can get out in 1 week because you need less of a movement,
Hmm.
right?
Hmm.
So
True.
meat and potatoes, risk management. This applies to
Yes.
me, you, and everybody else that's trading options. Everybody that's trading futures, everybody that's trading shares. So risk management and options, right, is very important. Risk small, only trade what you can afford to lose. A lot of people want to trade their rent money, right? A lot of people want to trade their gas money. A lot of people want to trade their healthcare insurance money. If you don't have it, you don't have it. Don't trade it, right? Practice paper trade, right? Practice simulation trade. So when you do have that some form of free capital, you can
Mhm.
actually get in the market to trade. Now, use stop losses. I hear this all the time. I don't have a stop loss. Why? You got $2,000 on the line. You willing to give up $2,000 because guess what? Any given time in the market, especially on SPX, NDX, especially on SPY, QQQ, IWM, especially on Tesla, it can go against you 50% in a blink of an eye. So stop
Yep.
losses protects you. All right.
Hmm.
Now, me personally, when I'm trading, it depends on what I'm trading. If I'm trading like individual stock, I always have a stop loss of 15 to 25%, 30%. But if I'm trading SPX, I have a 50% stop loss,
Hmm.
right? Anything that's under 1,000 on SPX is a 50% stop loss because I know SPX can move 10, 15 points against me. Boom. And then they can come back 17, 18, 20, 30 points
Oh, yeah.
to the
Because it
direction.
goes,
So
yeah.
it
Mhm.
depends on what your capital level is and what your risk appetite is, and then what your mental emotions is at that moment. Because a lot of people are very attached to money, which they should be because money is what actually pays our bill and keep us thriving as human beings. Now,
Mhm.
don't chase. I hear this all the time. I'm chasing. That's FOMO, fear of missing out. Don't chase it because I've been there before. If you chase, you chase, you chase, you lose, you lose, you lose. So you want to get to the point you missed it, wait on your next setup, especially if you're trading a strat. The strat is going to give you a setup. You
Mhm.
just have to be patient, no matter what time frame you on. Just be patient. Allow your setup to come around. Your next setup might be your best setup. It might be better than the first one.
Yeah.
So just be patient. Don't chase. Now, if you miss the move, let it go. Please let it go. I chased it in the past as a revenge trader. You will lose. You will blow your account.
Hmm.
Right? And if you
Yeah.
blow your account, ladies and gentlemen, sometimes you don't have the capital to get back if you have family, you got things that's going on. So guess what? You got to sit on the sideline maybe a week, maybe 2 weeks, maybe a month, maybe 3 months. This is going to give you time to practice that patience, right? So that's why I
Yeah.
say patience. Now, this is what keeps me very humble. Stay close to the money. right?
Stay
It
close to
depends
the
on what
money.
tickers, right? So if I'm trading like BAC, Verizon, I'm trading like BP, I'm trading small tickers, right? Especially companies that's worth under $1 billion. If I'm trading companies that's 2 billion and less, I'm getting close to the money because I know that ATR is pretty much $1, $2,
Hmm.
30 cents, 50 cents. Why would I trade $5 out of the money? It doesn't make sense. If it only
Hmm.
moves 30 cents, I'm trading at the money or I'm trading any money because if my delta is $100 and we move 30 cents, I make $30 per contract.
That's
Right.
good.
So
I'm
that's
glad
what
you
it's
said that.
about.
Yeah.
Yeah.
Hmm.
So I don't want to be able to try to chase it. Now, at the money or slightly in the money is safer and more stable. Right. So when it's safer and it's more stable, you feel a little bit more at ease. Right.
Hmm.
You say, you know what? Because implied volatility, theta is a hater is going to kill your contracts. Now, the next thing is trade with the trend. Trend is first, setup is second. Whatever the trend is, if it's bullish, okay. Now you're charting with the strat. If the strat's telling you it's a 2-2 continuation to the upside, boom, you got two confirmations, right? Don't trade
Yes.
against the trend and then you saying my setup is telling me to go long, but the trend is bearish. Right
Hmm.
there you
Hmm.
go. You don't have a you have a different variations, right? So you need to
Yes.
understand both variations need to match up, right? You need to know the trend is bullish, my setup is bullish, right? If both of them is the same, you can trade that setup. If one is against each other and you figure like you can trade that, I guarantee you 9 times out of 10 you're gonna lose money in that position. You might can hold it for a day or two, 3 days, 5 days, 6 days, and it might come back. But in that given moment, the trend is not your friend,
Right. No,
right?
that's a good point. That's a real good point. Yes. Hmm.
All
Hmm.
right, now taking profit is early. My whole thing is, I know you know John Smith, right? We work
Yep.
together. We help each other group out. So he got his concept trade four contracts, right?
Yes.
Four contracts. The first three contracts you take off the profit and you allow the last fourth one to run. So this works in this scenario. You want to secure 20 and 30% profit. Right? Don't get me wrong. You got guys that's doing 1,000%, 2,000%, 3,000%, like Levy K. She's smoking it. SPX, zero DTEs,
Hmm.
EODs, 1,000%. But as a new trader, you want to be able to lock in 20, 30, 40% profit consistently so you can feel comfortable within your trades, right? So you can
Hmm.
feel at ease. All right. Now you want to be strict too. You want to be able to cut it, right? So a lot of people say, you know what, I got 3 weeks on this contract, but if you're down 85%, you gotta
Yeah.
cut.
You
You
got
gotta
to cut
let it
that
go,
thing.
right? You gotta
That
cut it,
thing.
right? All right, now
Yeah.
you want to avoid trading news and low volume. So if it's low volume and it's news on that ticker, you want to avoid trading it. Because if
Okay.
news doesn't make volume spikes, you don't need to trade it because guess what? That's a negative, excuse me, that's a negative catalyst,
Mm.
right?
Hmm.
You want a positive catalyst when you in calls. You want a negative catalyst when you in puts.
Hmm.
Right?
Hmm.
So if Trump comes out, which is our president of the United States, come out tomorrow and said we are able to sell chips to Nvidia, able to sell chips to China, guess what that is? That's a positive catalyst,
Hmm.
right? But what just happened tonight, the Senate or the House just introduced a bill to stop him from allowing NVIDIA to sell chips to China. That's a negative catalyst. But NVIDIA
Yeah.
is the chip industry. So you see how news is going to
Hmm.
actually dictate what the candlestick does. Is either going to open up as a bullish two, a bearish two, is going to open up as an inside or outside candle because the news precede the candlesticks. Now,
True.
watch this. A lot of people get irked with this. Expect chop, expect fake outs. The
Okay.
market makers don't want you to make money.
Right.
They're
I
not
do
going to
agree.
allow you to make money. So you have to be willing to wait on some chop. You got to be willing to say, you know what, it's some fake outs that's going to happen. As these fake outs happens, guess what? I need to wait my trading setup. If it doesn't break my trading setup, I always got to say, if we break, we take. If we don't break, we don't take.
Mm.
Right? If
Okay.
the candlestick doesn't close above the price that I say I'm taking the calls or the puts, I don't take the trade. It can wick up it, come down. If it breaks above it, I'm taking, I feel comfortable, set up over and over and over again. Right? People say break and retest, that works as well. All right.
Hmm.
Now,
Hmm.
another thing, choose smart expiration. Man, we talked about this. When you're swinging, you want to have either short scalps or you want to take 1 to 3 week contracts, right? I don't care if earnings is coming up. I don't care about none of that. If you want to be a profitable trader, sometime it's best for you to trade longer contracts out. You want to be able to trade longer contracts. All right. So risk management is key. Risk management is key. If you
Hmm.
don't manage your risk, you're not going to be able to be profitable. All right.
Correct. Mhm.
What is an option chain? Wow, I get this question all the time when people want to come to option trading. So option chain is a visible representation of what you're about to get into, puts or calls. So you got different brokerages have different ways to do their option chain. We know that Robinhood is simple, it's easy. So an option chain is a chain list of all the puts and calls of the stocks. Expiration date, no matter if you're doing zero DTs, weekly, monthlies, leaps, and so on and so on. Strike prices, premium, bid, and ask, right? So we're going to get into those details. We want to get into is going to show implied volatility, volume, open interest, and Greeks. So we're going to break all of this down, how option chain actually work and how we can actually utilize the option chain to our benefit. So as an option trader, if you don't understand how to read the option chain, you should take a step back, get with a coach or a mentor, whoever's willing to teach you, or go to YouTube University, learn what an option chain have to offer before you get into a trade.
Mm-hmm. Mm-hmm.
Got it?
Got it.
All right, so let's get into it. First thing first, when I'm picking an option contract, I'm looking at expiration date, right? If I know a company have an ATR of $3, if I'm doing same week contracts, I can get $3 out of the money. If I'm
Okay.
using SPY, QQQ, IWM, I know I can get a zero DTE if it's $3 out of the money. I can go $3 out of the money. Now, if I know something moves $50 on an ATR, right? And let's say MSTR moves $20, almost $20 a day.
Mm-hmm.
Let's say I want to get a $400 strike price. I want to look and say, you know what? Let's say MSTR is lagging behind. Let's say it's only moving five, well, let's say $10 a day. I know from 200, $10 a day, 10 times is another 100, another 100, another 100. I know I need to take 30 days plus out. So I can take a quarterly contract, 200 or $100 out of the money because I know that the ATR can actually move towards that what? Strike price.
Yeah.
That's how it
Wow.
works. So expiration date is very important when you're picking strike prices. Don't worry about the price getting to that tomorrow. Don't worry about it getting that to the next day. You have 3 months on the contract, allow it to actually slowly creep up, right?
Okay.
Because it's going to get to that point eventually because of the ATR is going to continue to keep on compounding. It's going to continue to keep on growing, right? So you're just looking at quality days, quality weeks, and quality months when you are in longer swings.
Okay. And then not letting so in that type of situation, you take longer. So you're looking at monthly charts, maybe?
Monthly charts, quarterly charts.
Okay, you
Always
did
look
say that.
at
Okay, quarterly
quarterly,
charts.
quarterly and monthly charts. Break it down to the weekly, and then get down to the 12 and the 6 hours. And then I also enter on probably the 90-minute time frame. If I actually have a setup, let's say I have a 313 or
Hmm.
I have a 221, I like to actually take above in the strat world on the inside candles because it's giving me confirmation that the banks are stalling out for a particular reason. And then I go
Hmm.
read the news. Oh, this is why they're stalling out. They have a new chip coming out next week. So they want to be able to flush the inexperienced traders out, the retail traders, because they call us dumb money. So I want to be able to
Yeah.
sit where they at, and I want to be able to take the trade above my setup. So that's how it works.
And this brings up something I used to talk. Adix used to bring up, or does bring up. So you're in a contract that's a quarterly contract, even a monthly contract. You're not looking at every 15-minute bar going, okay, well, this is
Yeah.
you're not going to let even the 60-minute, you said 90, that's still some time so you're not letting every little candle just like, you're not sitting at, you're just sweating, looking at your phone, hoping it goes, or even looking at, the charts, sweating every little bar. And so
If I,
that's a different mindset. That's a different mindset. Hmm.
so now I try to tell traders get multiple accounts, right? So get your Leap
Okay.
account, and then you get your intraday and your zero DTA account, right?
Okay.
If you put your trades in your Leap accounts, you don't look at them probably about once a week, right?
I like
Because
it.
if you look at them on a daily basis, you're gonna have some form of trickery. It's gonna trick you out of trade. Oh, it went up, down, it's down $3, $4 is down, and then in all actuality, that's just the movement on the 1 hour, the 2 hour, the 3 hour time frame.
Hmm.
But on a weekly time frame, we're still bullish.
Yeah.
On a monthly time frame, we're still bullish. So that's why you got to separate your trades. You got to separate your quarterly swings, your monthly swings, and your leaps. You got to separate them in different accounts and your long-term investment in a different account and a zero DT intraday accounts. You got to have those specifically for that. You could check those periodically every 5 minutes if you're sitting in front of the computer, however you feel. But
Wow. That's
on your
good.
leaps, you don't want to look at that all the time.
No, that's good. That's good. That's a good distinction. I like the idea of putting it in a different accounts.
Now, what is option premium, right? So this is what people fail to realize what you're paying for a contract, right? So we want to break this down into something that makes more sense to a new trader, a beginner, or anybody that's experienced, because a lot of people don't understand how much premium they're paying. So premium is an option price that you're paying for an option, right? So either you're going to be buying at the bid or you're going to be buying at the X. If you're buying at the X, is a market order, you're aggressive. You say, you know what? I want to get in now. I want to take advantage of this trend on a 15-minute time frame. I want to take advantage of this trend on a 5-minute time frame, the 3-minute time frame. In my case, the 5 seconds, the 30 second, and I want to take full advantage of that. Now, my whole thing is if you're buying out the bid, you say, you know what, I'm less aggressive. I want price to come to me. I'm a little bit more settled today. You know what? I'm not willing to pay $30 for this contract. I'm willing to pay $5 for this contract. But if it never hits that price, I'm okay with that. So instant, this happens to me today, and it's going to happen to you as a trader, and it's going to happen to you as well. I had put a 200 contract limit order in for IWM, 253, $10. They only filled 9 of them. Those contracts went to almost $90.
Wow. Yeah.
Just let that sink in. I
Yeah.
was set being cheap, set a limit order at $10. They filled 9, and it took off. And me
Wow.
as a trader, once things start taking off, I don't like to chase it. But just think about that's a limit order. If I was aggressive and did market, $10 went to almost $90 a contract. So you do the math, that's over 800%. So
Yeah.
at 200 contracts, that's over $15,000 on a
Yeah.
trade. And the
Man.
contract cost you 2,000. So those are the things when you're actually buying contracts and contracts. So tomorrow I'm looking to do probably 400, 500 contracts. I'm looking to get them at $3 and $5, and I'm looking to sell them at 15.
Mm.
Because I already planned it out ahead of time. If we have a trending day, I'm gonna find
Yeah.
$3 to $5 contracts on IWM, buy 300 to 500 contract. Get in those contracts. If we move from $3 to $9, I take the trade off the table. That's 200%.
Man.
Looking to catch. So that's how I trade. Now,
Yeah.
watch how this works. If the cost of the contract is just like a price tag on a shirt. So when you go to the store, you're like, the shirt is $35, but if you see it on clearance at $15, you say, you know what? I like that. Right? So you know what I'm saying? You say, you know what? If you buy it right out, you guess what? You're being aggressive at $30. But you say, you know what? I'm gonna wait till the shirt go on clearance and I'm gonna buy it at a 50% discount. That's how you actually want to be able to approach the market as well. You don't want to overpay for an option contract when we have pullbacks in the market. So that's the break and retest strategy that you can actually use.
Mm.
All right. So that's
Okay.
basically pretty much bouncing off resistance, coming back to support.
Mm-hmm.
So that's
Yeah.
pretty much what you want to do in the market. So if a contract costs 1.20, the premium is $120 because every option contract is $100. You take the 1.20 times 100, which is 100 shares, and you get $120 for your premium. That's the money that you're putting on the line per contract.
Mm-hmm.
All right.
Mm-hmm.
Now, well, the premium can go up, the premium can go down. The reason the premium goes up and go down is because of what? Volatility.
Mm-hmm. Mm-hmm. Yeah.
Volatility increases the premium or decreases the premium. All right. So the stock price moves up, calls goes up, the stock goes up, puts go up when the stock goes down. So and vice versa. So if you want to put and you're looking at the premium as the put continue to keep on flushing to the downside, the price is increasing. Now you're in more profit. All right.
Mm-hmm.
Now I try to explain this to people. IV. So implied volatility. Implied volatility is your friend or your enemy.
Mm-hmm.
When you are in an option contract, implied volatility increase, that means the price of the contract is increasing. So if you bought a Tesla contract for 200 and Tesla goes up $20, them same contract is 2,000 because implied volatility.
Mm-hmm.
But if you bought a Tesla contract at 2,000 and implied volatility decreases, nobody is buying. Now that 2,000 is worth 200 because guess what? They didn't beat expectations on earnings. So implied
Yeah.
volatility is your friend or your enemy.
Yeah.
It
And
depends on when you get in it.
And implied volatility is also forward looking. I think that's the biggest distinction between implied volatility and then like historical volatility. Historical volatility is based on the actual back testing of the stock. So it's based on what real price did. Implied volatility is based on the premium and the price of contracts and the options. And yeah, sometimes, like
It's
you
basically
said,
a what if. It's basically a what if,
it's a
right?
big old what if.
The big old what if, right? So, and I try to explain to people implied volatility is a big old what if. You're thinking that the price is going to go here, but if they don't beat or exceed expectation, have
Yeah.
good forward guidance on earnings, you can wash your hands with that contract. It's over with. It's now 88, 92%, 95%. It's not coming back. All right.
Man.
Time until expiration date. That's theta. Theta is a hate. As soon as you get into a contract, theta is whacking you across the head. Less time, cheaper, but riskier, right? So premium, right? So premium equal risk plus time and volatility. That's the price that you pay for
Mhm.
enter a trade. So let's talk about this. All right. Let's talk about what is a strike price. Strike price is pretty simple. When we're trading an option contract, we're trading strike prices, right? We're either going to be bullish, we're either going to be bearish. A strike price is basically a price that you're say, you know what? I think that this price can get to here, right? It can be $1 out of the money, $3 out of the money, $4, $5 out of the money. You say, you know what? I think this company can move to the upside. I think this company can move to the downside, and I can be very what? Profitable. It can
Mm-hmm.
be very
Mm-hmm.
beneficial. So that's what a strike price is, no matter if you bullish or bearish. So if you're picking, let's say, a call strike price, let's say you picked a $100 strike price and the strike goes to 103, you're gaining volume. So guess what? You're gaining capital. So your contract is increasing. On the put side, if you pick a $100 put and the stock drops to 97, you're producing profit because it dropped $3 from your strike price. So that's
Mm-hmm.
how it works. You can do in the money, out of the money, or at the money. So let's get it. Now, this is what I want to talk about with you.
Okay.
This is very important. So it's this moneyness, right? And a lot of people get confused on how to trade options. Moneyness is pretty much just telling you either you're going to be trading ITM in the money, OTM out of the money, ATM at the money. That's all it means. Either you're going to be trading at the money contracts, in the money contracts, or out of the money contract. It doesn't matter. Whatever contracts you pick is just moneyness, right? So when you're trading in the money contracts, this is how it works. So if the example, if the stock is 110, you pick strike price $100, you're $10 in the money. That's the
Mm.
intrinsic volume.
Mm-hmm.
You already
Yes.
have $10 in intrinsic volume. Now, if you're looking to trade ATM at the money, if the strike is $100, you're picking $100 calls and $100 puts. These are very beneficial for traders because you take full advantage of gamma and delta at the same time. Gamma is running, delta accelerates your gamma.
Yes.
So that's why
Mm-hmm.
we're able to produce more profit when we actually take off in these trades. Now, to me, one of my favorite on like IWM, SPY, QQQ is OTM, out of the money contracts, because guess what? I can get more contracts if my technical analysis and my fundamental assessment is on point. They accelerate, right? So out of money
Mm-hmm.
contracts is a little bit more risky, but you can be more profitable. It depends on how many contracts you have as a trader. It's cheaper, but it's riskier, and you lose money fast because guess what? You don't have many variables that's going in your direction.
Mm.
So
Okay.
it's balanced, best for scalping, right? So it's best for scalping. It's cheap and it's risky. So it's
Okay.
best for
Okay.
scalping. Got it?
Yes.
Let's get it. All right, now what is open interest? Now, I know you know this famous thing online is becoming very important. Everybody is looking at flow, right? Flow knows, everybody understand what's happening behind the scenes, but take notes, ladies and gentlemen. The hedge funds and institution they're catching on, a majority of trades is done in a dark pool.
Mm-hmm.
If
Mm-hmm.
you don't have dark pool data, you don't understand what's going on with the institution. You don't understand who's buying a million shares, who's selling a million shares. But I'm gonna give you guys a clue. If Warren Buffett sold 600 million shares of Apple, it's only a handful of people that can acquire that many shares, right? Vanguard, BlackRock, State Street, Chase, Citibank, Wells Fargo. You have to look into these things, ladies and gentlemen. If you sell 600 million shares, who have the capital to be able to purchase these shares?
Mm-hmm.
Those are things that you want to look at. So a lot of trades is done in the dark pool now, but open interest. If you understand open interest, you can become a profitable trader. So open interest is a number of active contracts that exists for Pacific strike price and expiration date. These are contracts they haven't exercised. These are contracts they haven't sold. But I'm gonna give you a little clue. You can have open interest. It can be a fake out as well. You
On
can
open
have somebody
interest.
that bought a lot of contracts, $1 million contracts on the call side, and they can immediately sell them. But by the time you see them on Robinhood, E-Trade, these contracts can actually be liquidated.
Mm.
So that's something to keep your eyes on. Now, open interest is very important. It shows how many contracts is open, not closed across the entire market. So we're looking at the entire market. Now, when open interest matter is high liquidity, this means that it's easier to get in out of a trade. So I know in the past, as option trader, you like, I'm in a trade, I couldn't get out of the trade because they didn't have what? High open interest.
Mm-hmm.
Right? If it don't have high open interest, you won't be able to get in and out of trade. It won't have a close spread. So between the bid and the ask, it'll be pretty wide. So you're paying a higher spread. So now
Mm-hmm.
clean price actions, low open interest is risky, is bad feels, widespread. Now, example, this is how it works. If you have 12,500 contract, that's a high open interest. So if you see something like on Wells Fargo, you see something on Bank of America with $12,000 contract opener, your antenna should go up. So high open interest, good liquidity. Low interest is bad liquidity. Now on SPY today, the 690s for tomorrow, we got 52,000 volume, 18,000 open interest. So that means it's 18,000 contract on this option exchange from Robinhood that was swung into tomorrow.
Mm.
So they expecting for a move to go to the upside, right? So it's
Hmm. Hmm.
18,000 open interest, and these contracts are swung 52,000 times back and forth today. So if you look at the bid, you look at the axe as a dollar spread.
Hmm. Pretty
Bid and
tight.
axe is a dollar spread, so it's very tight. So I'm willing to get in this trade. If I buy 100 contract, I'm giving up $100. But if the spread was, let's say the axe was $15 and the bid was $8, I'm not willing to give up $7 to get in this contract because I got to make $10 to be what? Plus
Profitable.
profitable, right?
Yes. Yeah,
All right.
there's a lot of times you get yeah, if you don't look at that kind of stuff, especially bid and ask and spread, you think you're going to make this much money, but as soon as you sell it for a loss, or you sell
Right.
it at break even because you weren't looking at that. You didn't think it mattered. So yeah.
So,
Very good.
like an example, if the bid in the axe is 9 and 10, right? If I buy 100 contracts for $1,000, I'm giving them 100. But if I go to sell them, the bid in the axe is still going to be a dollar. Let's say it goes to 20 to 19. I'm losing $100. So I only
Hmm.
made $800 on this trade because I gave up 100 to get in and I gave up the 100 to get out. So
Hmm.
you want to be able to calculate when you actually trade an option because a lot of people are, oh, I didn't make any money because guess what? The bid and the axe. And you have to
Hmm.
give up the fee to get in these contracts. So the way theta and all these things work, we're going to break down these Greeks and we're going to get to it. All right. Volume. Volume is pretty much a match made in heaven for open interest. Volume is let me know the sum of contracts that's been sold back and forth for that given strike price and that given ticker. That's all volume is. So high volume, high open interest allow me to know what's moving in the market. So this instant, this is SPY same contract again. This time is SPX is 6,900 for tomorrow. So they're expecting for a move to the upside. It's 20,000 contract that was sold back and forth today, and the open interest is 11,968. So they're expecting for a move to the upside. We'll see if that actually works out as we move forward. All right. Bid and axe. We just talked about the axe is market order, the bid is a limit order, and we got something in between that's called a spread. So if the axe is $5 and the bid is $4.90, you're losing $10 to get into this contract, right?
Hmm.
So you want
Hmm.
to be able to pay close attention to what's going on. So that's how bid and the axe actually works, ladies and gentlemen. You want to take full advantage of that. All right, breaking even. I want to talk about this because a lot of people fail to realize this is actually a win. So when I'm into a contract, and let's say I'm up 100, I go down 100 and I go back even. Breaking even is actually to me is a positive position because I'm able to keep my capital minus the
Hmm.
fees that I actually got into the trade. So now I can use that capital to be able to trade another trade. So breaking even is a good thing. But now, option trading breaking even refer to the price point in which a trade neither makes a profit or incur a loss. So basically, this is how it is work is a formula. Strike price is $50, the premium is $3, so break even is $53. That's how
Hmm.
it works, right? So remember, you're being charged a fee to get in and out of these contracts. So if I can break even, I can walk away with just the fee that to process the transaction. I'm happy with that because I can use that capital to trade another trade on a given any given other day. So that's
Yep.
what it. All right, breaking even. All right, intrinsic volume. I don't know if people talk about this, but this is just a big word for what your contract is worth. I'm going to give it to you in a nutshell. Intrinsic volume is an option trade in real time, right? So in the money. So this is how it works. Intrinsic volume. If I buy a contract for 500 and I make 500, my intrinsic volume is $1,000 if I was to go
Ah.
sell it.
Hmm.
That's what intrinsic volume is just worth. It's just the volume of your contract. It's just the big words to actually put traders in a bind, right? Oh, I don't know what this means. No, it's just what your contract is worth if you was to go to sell it or exercise it. That's all it was. That's just intrinsic volume. Now, most important thing outside of intrinsic volume is extrinsic volume.
Hmm.
This is what a lot of traders get tricked up at. This is very important. This is the volume part of the price that comes from volatility. So basically, what this is saying it's simple. Intrinsic volume equals time volume plus volatility volume. So you actually just say, this is the amount that I'm paying for a chance for the trade to go in the money or go towards the money. So you're paying a little bit more, right? So the components of this is very important. I tell people, look at this, break it down. If you understand this, you can become more of a profitable trader. So it means extrinsic volume is what the option is worth right now based off of the price.
Hmm.
Extrinsic volume is the extra you pay for time and potential movement. So that's what intrinsic value you're looking for potential movement to go to the upside. Strike
Hmm.
price is 45, call strike price is 45. So you have a $5 intrinsic volume. So this is how these things actually work. So this is why when you trade zero DTE contracts, they move pretty fast because guess what? They don't understand what's going on in the market. So extrinsic volume, intrinsic volume, these are things I tell people to lock in on, lock in on and
Okay.
lock.
Okay.
So let's get it. Intrinsic volume is what you have. Extrinsic volume is what you're hoping for. Remember that.
Okay.
Intrinsic volume is what you have because you pretty much bought in the money contracts. And extrinsic volume is you paying time for those contracts. This is what you're hoping for.
Oh,
That's
okay, okay.
basically what it is. That's what you're hoping for. All right, next thing, fun fact. 19% of options are exercised. All those
Really?
on expiration date.
Hmm.
17%. Now, 35% of option contract expires worthless. So let that sink in.
Yeah.
35%. Now, 40% are closed before expiration date, right? They
Hmm.
sell them for what? A profit, or they
Profit.
sell them
Yeah.
for a what? Or a loss.
Loss.
But
Yeah.
35% of the contracts expires worthless, so pretty much like zero DTEs, or somebody that's holding like a monthly contract and is down 95%. They're like, I'm just gonna let
Man.
it go. I'm just gonna let it go. So that's just a pie for people that's trading options. So looking at a pie and understanding what's going on, this is the representation, right? Now,
Yep. Mhm.
let's talk about this strat. The VIX.
Yes.
This
The
is one of the
VIX.
key metrics to trading options. If you don't have the VIX index next to you while you're trading SPY, QQQ, and IWM, you won't win,
I agree. I
right?
agree.
Because they are inverse. So the VIX index was created by the Chicago Board of Exchange. It measures 30 days out and ahead of time. It's measuring the volatility in the market. As
Yes.
volatility spikes, guess what happens to the market? The market goes down because the VIX is going up. As the VIX go down, the market is going up.
And I expand on
Go do
that?
your thing.
All right, all right. And the reason why that happens is because, and this is why they call it the fear indicator, is because they're actually measuring how many puts people are buying, put options they're buying to hedge and protect their positions. So when SPY starts moving down, you'll see VIX start moving up because they're like, nah, I need to buy that insurance. I need to protect my position. Now, I will say there are situations where I've seen SPY go up and I've also seen VIX go up at the same time because the buyers are like, I don't trust this move. I don't trust this. So they're protecting their positions. So they're buying those options. Now, usually those type of situations are rare and they're like 1 or 2 days, like say a Friday, over the weekend, and you'll see it Monday it drop back down, Tuesday VIX drops back down. But I have seen that, and that's exactly what. So I'll let you keep going with VIX, but I definitely wanted to say people are buying put options to protect their positions.
All right. Now, another thing that people fail to realize was very important when I'm looking at the VIX, like you said, is the fear and greed,
Mm-hmm.
right? If it's fear in the market, nobody is buying, right?
Mm-hmm.
When it's
Yeah.
happiness, euphoria in the market, everybody is
Everybody's buying right now.
everybody is buying. Now, you want to buy the fear and you want to sell the greed, right? You
Okay.
want to buy things when nobody else wants it. So,
Okay.
like on SPY, SPX, QQQ in the morning, right? So we know the market pivots at a certain time. If there's a lot of fear in the market, nobody is buying. But if you see your setup, you see, let's say 312, right? Or 132. If you see this setup, if it's a bullish three, you understand that it took out the low and then it took out the high. Now it's a continuation. So guess what?
Mhm.
You want to buy the contracts while they're cheap. When everybody is being fearful, you buy them at $3. When everybody gets in and start buying, they at $15. You sell off and momentum leaves the market and it leaves them stuck holding the bag. Because
Interesting.
you was willing to buy the fear, they was willing to buy the greed, right? So you want to buy when things are cheap and things are low, and you want to ride the momentum.
Okay. Okay.
Volatility, we talked about this earlier. What volatility means, right? Volatility is the market volatility and frequency of price swings, right? We understand that the market is going to have volatility points on the weekly, the daily, the quarterly, 15, 30 minute. But if we understand how volatility can benefit us, we can actually trade it as a trader. So volatility is just up and down movement of the market. Higher volatility mean wider expectation for price, right? So that's why they charge you more money for option contract. Because like on Tesla contracts is pretty what? Expensive because
Expensive.
moves, right?
Yeah.
Very erratic moves. So that's pretty much volatility,
It's
right?
the it's the world's worst roller coaster. It's $10 up and $10 down. It goes like this. It's if it was a roller coaster, you go straight up vertical, it would curve and go straight back down. There ain't no cute little banking and doing all like no. It's straight up and straight down.
That remind me of the roller coaster in Sandusky, Ohio, the dragster
Yeah.
that my wife and people got on. So
Uh-huh.
it really straight up and drop you on your head. Right? All was going up, you said, "Whoa, I can sell. I'm euphoria." And then guess what? You being a little bit greedy, you stayed in the trade. You
Yeah.
and it falls. So that's what volatility is. Now, you just talked about historical volatility versus implied volatility. The history of a company makes more sense. If Coca-Cola is more volatile in the third quarter, why would I not be patient? If
Hmm.
it's less volatile in the first quarter, this is my time to get in.
Hmm.
Right? I want to do longer swings to the third quarter because guess what? I know this is a settled state when the contracts are cheaper. So
Hmm.
historical volatility is giving you the history when a company is very volatile or least volatile. We understand that Tesla is always volatile. So my whole
Yeah.
thing is the best point is to be able to trade from pivot points. Support, being able to trade Fibonacci retracement levels. All these things will help you on Tesla, but you have to be poised. Now, we talked about imply. When you imply something that doesn't happen, your contracts get ate up. It's just that simple. All right. Interest
Hey,
rates.
before you get into that, I want everybody to know I said all I said about for historical volatility and implied volatility. I said all that, and I didn't even know that slide was there. So that we are doing this.
Yes. We, we on the page. We on the page. Now, interest rate. This is important. When the Fed speak, it's not going to pretty much affect your contracts unless you have quarterly contracts out. Because
Okay.
it is a money thing, right? So if the interest rate is high, there's less money in the market. So that means,
Okay.
guess what? They're going to be charging you more money for a premium because guess what? They are being charged more money. If I wanted to borrow $1 million, would you rather borrow that 6% or 10%?
Right, 6%. Yeah.
6%. So interest rate is going
Mhm.
to affect quarterly contracts and contracts that's further out. Now, if you're trading zero DTEs and John Wick get up there, which we call him Mr. Powell, if he get
Uh,
up there and he say something crazy, we get a lot of volatility, right? So that can actually affect it. But on any given day, interest rate is not going to affect your zero DTEs. It's not going to affect your intraday. It's not going to affect your weekly contracts because we don't have interest rate decision every day. We don't
true.
have interest rate decision every week, right? So interest rate is not going to affect your option contracts, but it will affect your leaps and it will affect your quarterly contracts because every 90 days or so on and things like that, the Fed come together, they make a decision if they're going to raise rate, lower rates, or keep them the same. All right.
Okay.
So think
Yes.
about interest rate when Powell speak. Just think about Powell as a three.
Ah,
Powell
okay.
is
Yeah, yeah.
taking out both sides of the candle, and when he become calm after the meeting, it goes into an inside candle, and it bakes
Hmm.
for a little bit a minute, and either we're going to take out the high of the three or the low of the three. That's if you
Hmm.
go back and back test it, you will see what's going on in the market. All right, Greeks. Let's
Greeks.
talk about this. So this is how we make our money, ladies and gentlemen. So I know a lot of people say, "Oh, I wish I can just trade options without Greeks." It wouldn't benefit the market makers. It
Right.
wouldn't benefit the institutions. It'd be
It,
too easy,
it
right?
wouldn't be, it wouldn't benefit the people that are writing the contracts as well.
Right.
Yeah,
It wouldn't.
same. Hmm.
Because guess what? The seller benefits from theta, right? The
Hmm.
seller benefit from time decay. So the Greeks, we got delta, gamma, theta, vega, and rho. These are not sororities, ladies and gentlemen. These are metrics and options. So delta is the amount of option price change for $1 movement to the upside or to the downside. So the way delta works, delta can go from 0 to 100. That's the maximum, right? No matter how far you in the money, the highest delta you can get is $100. But if you imply 10 contract, you make $1,000 every dollar that it moves. But if it goes against you, you lose $1,000. Now, gamma
Hmm.
is related to delta. They pretty much like twin brothers. So the rate of change for delta for every dollar change in the underlying security. So these contracts is very prevalent to take advantage of delta and gamma is at the money. Theta is a hater, time decay. As soon as you get into a contract, theta is taken away. The longer you stay in the contract, theta is going to take away. So that's why you have to have delta and gamma goes in your direction. Vegas, implied volatility. We know that interest rate, if interest rate changes for quarterly contract, this can actually hurt or help our contracts. And rho is interest rate. So let's talk about this. All right. Now, let's talk about delta. All right. We're going to sum this up. So delta is option Greeks. And a lot of people ask me all the time, what is Greeks? What is Greeks? You shouldn't trade option contracts if you don't understand Greeks. You don't know how you're getting paid. If you don't
Hmm.
know how you're getting paid, why would you trade? Right? That's just
Hmm.
like you going to work and say, hey, I need a paycheck, but they haven't taught you anything. So how are you going to get paid? That means you can't
Hmm.
work. So
Yeah.
that's why you have a grace period. Hey, we're going to train you. So if it comes to option trading, you need to learn. Right? It's the same principle, right? You want to learn this because once you learn this, you master this, you can't unlearn it.
Hmm.
Right? So this
True.
is just another way to make money. So delta measure has the option price changes when the price actually spikes to the upside or to the downside. Delta can be positive or negative. On the put side, delta is negative. On the call side, delta is positive. So delta just basically sensitivity price movement, right? As prices increases or decreases, delta changes. Now, I want to talk about this, how we can actually use this to benefit us. If an option has a delta of 0.5, that's $50 because we times it times 100 contract. But I
Mhm.
want you guys to write this down. This is a note. If you have a delta of 50, that's a 50% chance of that delta ending up in the money. If you have a delta of $30, you got a 30% chance of that contract ending up in the money. This is why institutions and hedge funds buy in the money and a delta is 100 because they know they got a 100% chance of this contract staying in the money. So
Mhm.
that's how you actually measure delta. The higher your delta, the higher probability you have for a payout.
Mhm.
Right?
This was years ago now. We asked I don't know if you guys, some of you guys remember out there, Strat. He did a options class with us way back. Rob was still alive with us, and he did that with them. And he was talking about how he does not take contracts unless it has a delta of zero point 0.7. That's pretty high, and the contracts are pretty expensive at that level. But he's going to be making money. He's got a 70% chance of that thing being profitable. Hmm.
Right. And I'm gonna explain to you what type of trader he is. Let's get to
Hmm.
it. So when we're talking about a delta, we need to understand this is how we make money as traders. So if this is how you make money, you want to study this thing, right? Because if you get it right, you make money. If you get it wrong, you don't make money. You lose capital. So delta means, right? So if you use a 0 to 30 delta, these are cheap contracts. These are out of the money contracts, right?
Hmm.
These are
Hmm.
out of money contracts. They fast but risky, right? So that's for people that trade in zero DTs, EODs. They're not trading out the money. They're not trading in the money on no SPX.
Right.
Because guess what? Guess what happens? Your contracts get what? Smoked.
Yeah. Hmm.
All right. Now, let's say that's scalping momentum, right? Now, let's say you're looking for a balance to risk reward, right? So I try to explain to people balance to risk reward. Most day traders should be trading 0 to 100 delta, right?
Hmm.
Because this gives you a higher risk to reward, right? You might not be able to get 50 contracts, but you can get 5 contracts if SPY moves, let's say $5. Let's say if Johnson and Johnson moves $1.50 and you bought 5 contracts out of money, your delta is 80. 80 times 5, you do the math, right?
Yeah.
You're pretty
Yeah.
much making a decent return. So this is what it's about. Understanding what bracket you need to fall in as a option trader, the delta will actually show you.
Okay.
Right? Delta will show you. Now, low delta, this is what I try to tell people. When we trade in the money contract, is high accuracy, and this is trend traders. Right? This is people say, I'm not messing around. I'm just looking for a dollar move. When you guys see those option chain is heavy with volume and open interest, they looking to get in and out while you still holding the bag. Right?
Hmm.
Now,
Hmm.
low delta, cheaper but need big movement. High delta, more expensive but more reliable. So
Hmm.
delta is your confidence. That's all delta means. It's your confidence. Your
Hmm.
confidence in the trade. You say, you know what? Like Lovey K, she's very confident in her
Yeah.
trades. She said, I'm gonna take the 0 DT. I'm gonna spend 300. I'm gonna spend $150 on this contract, and guess what's gonna happen? It's gonna accelerate because guess what? She's confident in her delta that she's picking.
Yeah.
So confidence is what delta stands for, and it's
Okay.
probability. So delta is confidence and probability, right? So you want to be able to understand what's going on, right? Probability. Now, this is what I try to tell people: real world use. When you're scalping 0 DTs, we don't want to show what slow contracts, because if your
Right.
contracts are slows on 0 DTs, theta kills you up, and guess what? You don't make any money. So that's what it's all about. Pay close attention. All right, theta is a hater. What can we say about theta? So, only thing that we need to understand about theta is time decay. So, the
Hmm.
longer you stay in the contract, the more money you lose off of theta. So, if your theta is 0.10, you understand that you're losing what? $10 per contract, right? You
Hmm. Hmm.
understand that if your theta is $25 a day, you're losing $25 a contract. So, when you start compounding it at 10 contracts times $10, you're losing $100 a day. So that's what theta is. So you want to make sure that your delta is out accumulating or outgrowing your what? Your theta.
Theta. Hmm.
Right? So theta is a hater, ladies and gentlemen. And guess who benefit from theta? The seller of the contract.
Hmm.
So they want time to go against you because they want you to be able to exit the position or lose all the money of your premium so they can pretty much keep it. All right. There you
Yeah.
go. All right.
Yep.
Theta is a hater. Now, I got a question for you. When you
Okay.
first started out as theta, right? You didn't understand it, right? Like, wow, what is going on? Right? And then you came to the realization that theta is a hater, but it's a way to keep theta at bay. It's two ways: taking
Okay.
profit and buying
Yep.
time.
But okay. Yes. That no.
If
Connect the
you have
dots. We're
if
connecting dots now,
let's
people.
let's connect the dots. So if I take profit, they'd have less time to actually chew me up.
Hmm.
If I have 6 months on the contract, Theta doesn't accelerate that fast because I have still 6 months on the contract. But if I buy a daily contract or a 2 day or 3 day contract, Theta is eating up my contract because I have to get out of these contracts as soon as what possible.
Awesome.
But if I have 6 months, guess what? Theta is no bother. If my data is $2 a day and I have a 6 month contract, doesn't matter. It's
Yeah.
$2 a day. If I make $10 a day, I still outweigh that by making $8 a day.
Hmm.
So
Hmm.
that's two ways to keep theta at bay: taking profit and buying time.
Nice.
All right.
That's pretty
Vega,
simple.
man, they don't talk about this enough, but this is simple. This is
The,
implied
the,
volatility.
the only Vega I know is Vega from Street Fighter 2. That's the
Right,
only Vega I know.
right. So Vega to me is just implied volatility is how essentially the option price changes, right? So basically what this is, ladies and gentlemen, when implied volatility increases, the contract increases is going to cost you a little bit more money to be able to afford this contract, right? When IV is low, contracts are cheap. So, like MDB the other day, it
Okay.
was 300 a contract because implied volatility was low. They wasn't expecting a 75 or $80 move. And guess what? Implied volatility increased. The contract went from 300 to 2,200 to 2,000 a contract because of implied volatility.
Hmm.
That's
Hmm.
all what Vega is implied volatility. Bad call before earnings, and you're taking a gamble, right?
Yeah.
Because guess what? If it doesn't meet expectation, beat expectation, or it exceed expectation, guess what happens? It IV crush. It kills your
Yes.
contract.
Hmm.
All right. So it goes back to an implied move. What is the implied move? It's 5%, 3%, 10%. If it don't meet the implied move or exceed the implied move, your contracts is dead in the water. All right. Row. Sensitivity to interest rates. So we understand if interest rates should change, it's going to affect your contracts 3 months, 6 months, 9 months, 12 months, 36 months out. That's what row is basically sensitivity to interest rate. All right.
Hmm. Hmm.
Gamma. This is important. Gamma and delta is what I look for. I look for theta. When I'm trading zero DTs, I don't care about theta.
Hmm.
I'm in and out of the contracts, but if I'm trading a week, 2 weeks, I'm looking at theta, right? Because I want to
Hmm.
understand if theta is $3 and I got 300 contracts, I understand that I'm losing a lot of money every day. Now,
Yeah.
gamma measure how fails delta changes when the stock prices move, right? So delta is speed and gamma is acceleration. So as
Okay.
delta increases, gamma accelerates delta, and then that's how we make a lot of money off our contracts, especially for contracts that's at the money.
So is this where people talk about gamma spikes and things like that?
Gamma spikes,
Hmm.
GEX. We understand that gamma flips and things like that. This is how we make money, right? We
Okay.
want to understand which contracts have the high probability of us making more money. It's at the money contracts and when we putting in gamma, right? But out of the money contracts, if we move and have a spike in price, we make a lot of money as well. Because as though out of money contracts get closer to at the money or in the money, now we're benefiting from gamma as well.
Hmm.
Got
Yeah.
it? All right.
Yes.
This is an example. It's simple. Delta is 40, gamma is 10. As it accelerates, we make $50.
Ah.
And as we get closer and closer to the money or in the money, the delta changes. It goes from 50 to 60, 60 to 65, 65 to 68 to 70 and 80. So as price increases, your delta changes. Your delta doesn't say to change since you bought it. It changes, right? Because
Okay.
price is increasing. All right. And the next move is price make the contract move any faster. This is why breakouts can send contracts flying. People say, wow, this contract went from $30 to $300 because guess what? Delta accelerated. Gamma
Yeah.
is increasing, right? And
Mhm.
Delta is increasing. Now you're making money. So this is why it's very important to understand what's going on. But this is how you can get chopped. Why gamma matters, right? If you chopping you sideways, it's low gamma. You're not making any money because we're not moving, right? But if we're
Mhm.
trending and we have breakouts today, like IWM and things like that, SPX on any
Mhm.
given day, that means the gamma is what? Accelerating the what? Contracts. This is
Yes.
how we make money. So it shows up, especially for SPX, SPY, IWM, especially when you're scalping anywhere between 2 o'clock and 3:45 p.m. Eastern. All right.
Okay.
Charm. I try to explain to people these are two Greeks that a lot of people don't look into, but it's going to be charm and another one, right? So charm is delta decay over time. So this charm measure how delta changes as it passes, right? Even if price doesn't move. So people say, oh, wow, price is not moving. I'm losing on my contract. It's charm, right? It fades through the chop. So if you get into a contract and you're chopping and then you finally move a dollar and you chop, you finally move a dollar and you chop, 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 you're not going to make any money because your contracts is getting chopped up, right? So you need what? Immediately movement, right? You need a trend. This is how charm actually measures. So your contract is melting. This is why contracts melt because of charm. Contracts and melts, right? You're not making any money. It's going sideways, and you holding through consolidation, and this is killing your premium, right?
Yeah.
Waiting is very expensive. I try to tell people waiting is very expensive when you're doing zero DTEs in same days
Yeah.
and you're
Yeah.
doing scalps. Waiting
Mhm.
is expensive. You can get out of the contracts and re-enter when you get the trend in your direction. So once you wait into a trade, if it doesn't cook in your direction, you're going to get cooked. So you want to pay close attention to what's going on. Charm is stronger with zero DTE, same week option, and it punish hesitation. When we just talked about that, if you hesitant in your trade when your setup is there, another one is coming. So take the next one. Don't jump into this, and then now it's chopping. So
Yeah.
now your contracts is actually getting battered, right? So the
Mhm.
tank is rolling over your contracts. Your contract is pretty much what?
Yeah.
Dead. Dead in the
Dead.
water.
Yeah.
So that's why we want to pay closer. If price ain't moving, your delta is dying. We need price
Yes.
to move.
hmm
If price is not moving, your delta is down. You're not making any what? Any profit.
Yeah. And then
All
and
right.
but then yeah, but then we get into a situation where you're talking about iron condors and iron butterflies and all that wild stuff. So what is Vela?
All right, now this is another one. This is delta change when volatility change. And Valor shows how delta change when implied volatility raise or fall. So these are Greeks that a lot of people don't look forward to, and they don't understand that's playing in the background that's actually killing your contract slowly, right?
Mm,
So when you get into these things actually change you as an option trader. Now you can actually size up or size down, right?
okay.
So this is Greek that controls IV crush. This is what controls
Oh.
IV. This is what
Oh.
controls your IV. So when IV goes up, contracts inflate, they get more expensive. When IV
Hmm.
goes down, contracts deflate, they become less what valuable.
So I've never seen Charm or Havana uh displayed like like you said in the options chain. Is that something that you could where would you find to look that stuff up?
It's different brokers, right? So you can go
Okay.
online. Every brokerage, Robinhood is not going to offer it, right? But you can go to like different brokerages. They
Okay.
offer it, right? And then every day you can look at your option contract. You can go to like bar charts and things like that that can actually help you, right?
Let me see if trend. Let me see if now
If
you're talking
transpire
about it. Let me see if Trade Station has that because um see I'm talking. See now I'm looking. Now I gotta look because
That's what I
I'm
like.
learning.
That's what I like. Got
I'm
you thinking.
learning.
Now, let's talk about this. This is why buying before earnings is a trap. News pump fade, right? Hype candle punish chasers. So people say, I'm gonna swing 100 contracts to earn. I think the video is going to the moon. Guess what? Vanna says no.
Yeah, yeah, yeah,
It
yeah.
says no. It
It's
says,
like
guess what?
it's like that meme where yeah, it's going to the moon. You got the moon and then you got priced out. You there now here's the moon down here, the price, and it goes straight to the moon. Anyway, that's a dumb joke.
And then this is what makes sense. Price can be right, but time it can be wrong. Price
Mhm.
can be right, but time it can be wrong. Vanna is going to decide your payout. Right? So let's get it.
Interesting.
Why this matters, especially for zero DT's Greek show, right? Charm
Mhm.
Delta bleeds with time, right? Tells you don't hold your chop. Do not hold through the chop if you have some resources and capital to get back into the trade, right? Because if you get into a trade that goes against you and it start chopping, get out, and if it actually hits your next target, your TP take profit, you can get into the trade to your next TP take profit. So
Mhm.
that's all the things that you want to pay. And Delta shift with IV tells you avoid what? Hype and earnings trap, right? They
Mhm.
want to trap you into earnings, right? So that's why
Yeah.
a lot of people play earnings reaction now. This is how you avoid it. Contracts down during consolidation, getting IV crush after the move already happened. This is what a lot of people
Mhm.
do. They want to ride the move. This is why we have squeezes. I'm going to ride this move. Is that all time high? Not me. I'm going to let it go without me. All right.
Uh,
Being right on direction, but losing money anyway. So this is how you actually get killed on contracts because guess what? You can have the right setup, but the wrong time,
mm,
right? Because a
yeah.
little hesitation can actually put you in a mood to pump fake you out of a trade.
Mhm.
All right.
Mhm.
Master these and your rent rate will actually continue to keep on exploding. Now, we talked about the percentage wise. I wanted to bring this back up because I don't think people really understand this. 17% of option contract is exercise. So guess what? People are taking shares away. They're building up wealth.
Mhm.
Got it? 48% of contracts expires what? What happens?
Yeah, they expire. Go offset trade. Sell close. They're taking profits. They're taking profits.
There you go.
Hmm.
They're taking profit. So you want to be in the business of the 48%, or you
Yes.
want to be in the business of the 17%.
Hmm.
Make sense? Let's get it.
Yes.
All right. Two most important Greeks, delta and theta. It's going to determine how much money you get paid. So as you guys can see, this is an option chain. It's pretty old, but you fail to realize the axe price, 870, $20 strike price, current price is 28.60. So it's pretty much $8.60 in the money. The delta is 100. Now,
Hmm.
in this instant, if I'm a trader and I want to make legit money fast, I would trade this. I would get
Hmm.
in this contract for 870, but I'm losing $10.
Hmm.
Now, but I got $100 delta. Now, watch how this works. So if we move from 28.60 to 38.60, that's a $10 move.
Hmm.
$10 times my delta of 100, I make $1,000 for that one contract. I'm happy. I just
Yeah.
made $1,000. But what if I tell you that's the wrong move?
How? How is
All
that
right.
the wrong move?
It's the wrong move, right? I still can trade 27.50 is in the money, right?
Yeah.
27.50 is in the money. The contract is 144.
A lot
I can
cheaper.
get six whole contracts, right? Six whole contracts. All right. We do a little bit of math, right? I try to
Okay.
explain to people math is fundamentals, right?
Fundamental. I was about to say it.
144 times six, I pay $864 for six contracts. Got it? And
Okay.
my delta is what? 0.779. So $80 what? Every move.
Yeah.
We move the same $10. I make $800 per contract because I have six contracts now.
Yeah. As opposed to the one.
So I
Same.
make 4,800 profit plus my original investment because I get to keep my premium. So
Yeah.
which one makes more sense? Trading $100 delta or trading an $80 delta?
The $80 delta in this situation.
That's
Definitely.
how you make money.
Wow.
You don't always have to
Interesting.
trade the highest delta. You can trade a delta that makes more sense. You have multiple contracts. Because if I do six contracts, let's say I sell five and I let one run.
Hmm.
But if I
Yeah.
just do one contract, once I rinse my hands with it, it's over with.
It's gotta go.
There
And
you
it's
go.
got, yeah. It's gotta
There you
work.
go. Now, looking at this contract, we understand we got theta all the way in the money. Is what theta is not doing anything. I
Mm.
theta. If my theta is $3 a day per contract, ladies and gentlemen, I'm losing $3 per day per contract. But if I got 10 contracts, I'm losing 30. If I got 100 contracts, and so on and so on from there. Now,
Mhm.
these are the things that I like to tell people. The most important thing about option is understanding the company. If you don't know what Tesla sells,
You going back to fundamentals again. Daggone it.
how can you trade it? Just think about this. How can you trade a company?
Here
If
we
you
go.
don't
I
know
got
that
one for you.
Tesla, people go ahead.
I was gonna say I got you. I got you. So I got one for you. What is Tesla listed under? Is it a car
Tesla
company?
is a multifaceted company. They saying it's a technology company, but it's not a car company. It's multifaceted.
That's what I was looking for because that's exactly what I was going to say. A lot of people focus on the cars and it's all about the cars and the robo taxi and everything, but Tesla themselves say they are a tech company, a software company. I'm pretty sure it was a software company I heard, but I'll go with
They're gonna
tech. Same thing,
they're gonna
same
make
thing.
more money from humanoid robots than they ever make from cars.
Mm-hmm. Yeah,
Uh,
and yeah. Mm-hmm.
Right? Because everybody will be able to afford a humanoid if it's 10,000, if it's 15,000, people will be able to afford a humanoid, right? People can't afford a 30, 40, 50, $60,000 car. So to me, Tesla is very innovative, and I'm gonna put this out on the record. Tesla is a $2,000 company. It can actually 5x from where it's at. It's basically looking at the history and what Tesla can go with the products that they have with the demand. Tesla
Mm-hmm.
is just pretty much iRobot
Yeah.
with Will
Mm-hmm.
Smith. That's all it is. They just building up the infrastructure, and Tesla is going to be the primary vehicle that actually controls that infrastructure. Right? Tesla's going to
Mm-hmm.
be controlling the cars. It's going to be controlling the charging station. It's going to be controlling the humanoids, and we're going to move forward from there.
Man,
So,
now, I just want to, yeah, that was definitely just dovetailing into what you're saying about knowing what the company actually does.
right.
So,
So I try to explain to people the most important is understand the company and this movement. Know when companies move. Know if companies move around holiday season. Know like if HD, Home Depot, and Lowe's do they move around hurricane season?
mm,
Right? understanding the movement, right? Because I think as we move forward, one of the most profitable companies in the world, which is Apple, if Apple comes out with what I said over the last couple of years is healthcare pods, Apple will be worth $7 trillion.
Mm.
They already is in the healthcare business with your Apple Watch. So if Apple can come out with a healthcare pod, you can walk into the pod and it can tell you your heart rate, your blood
Mm-hmm.
pressure, it can tell you your sugar level, it can tell you if you're obese. Apple would change the game because guess what? You're gonna not need more how you standalone facilities for hospitals. You can come in there, the pod can tell you what's going on, it can actually give you a prescription, and it can actually send you on your way. I think that Apple would
Man.
need to get into things like that. All right, here
That,
we
that,
go. A few more slides.
the Apple Pod said I need a backiotomy. That's what.
Yeah. Yeah. Trust me, it's
I'm
coming.
being silly. I'm being silly.
Coming. Because think about it's HCA. All right, is a
Hmm.
ticker. You can look it up. They're in the
Hmm.
healthcare like Humana.
Yes,
HCA, they got standalone facilities here. Well, you
hmm,
don't have nobody check you in, you check in through a computer.
that's happening right now.
AI. Right now.
Wow.
Remember,
Okay.
I went to school to be an X-ray tech.
Yes, that's true.
Yeah.
You did say that.
So
Yeah.
and I seen the humanoids was passing out meds. Yeah, years
Man,
ago. So
Dave,
it's
you're
coming.
blowing my mind.
It's coming.
I got my hair with my little dumb jokes, trying to, just trying to keep it, and you are dropping all kind of gems, and you're definitely forward thinking,
You're
forward thinking.
always innovative. That's why I told you when I send you something about long term, I
Hmm.
done already
Yeah.
did my research. Yeah, yeah. I already been top to bottom 10 times. Now, remember we talked about earlier how volume makes sense. This is today.
Hmm.
This is volume, option volume, daily average volume. When you look at the list, you can literally pick this up from yesterday and say, what was the volume on this stock? MSTR, BAC, Intel, Apple. So now you can make a decision which companies moved yesterday. Are they going to move today? Did these companies hit a 52-week high? Did they hit an all-time high? Did these companies hit
Hmm.
a 52-week low? Now you can make your decision based off of call volume and put options, put volume, and then now you can look at the ratio, right? Is it
Hmm.
more calls than it is puts? Now you can look at the ratio and say, oh, this makes more sense. I want to trade this, right? So this is what volume looks like on any given day. Now,
Hmm.
lost opportunity risk. We need to throw this out there for everybody. We need to throw this out there. Lost opportunity risk is option trading, is the risk of trying to what? Tying up capital. A lot of people tie up capital in trades that they only believe 50% in or 25% in.
Hmm.
So when a trade do come along that they believe 100% in, they don't have any capital. Maybe
Hmm.
they've blown their count. Maybe they have 80% of their capital, 30%, and 40% of their capital tied up into a trade that's only going to make them 10% instead of a trade that's going to make them 100% or 1,000%.
And are they doing that because they're afraid of missing trades? Is that what you were getting at?
Maybe it's peer pressure, right? A lot of people on
Mhm.
social media, they see people online making 100%, 10,000%, 8,000%. So they're chasing the same opportunity that they're chasing instead of just trading their system and tickers that they trade over and over against. Like for
Hmm.
me, example, I trade BAC, I trade Verizon. So tomorrow I know that I'm gonna be trading BAC. I know I'm gonna be trading Verizon.
Hmm.
They
Hmm.
move on Fridays, right? Either up or down. I know those are positions that I'm looking at for sure.
Yeah,
Right?
and a lot of times, a lot of these people that are putting out, 10, 500%. You could buy a piece of crap out of the money stock. Excuse me, a piece of crap
For
out of the money
$2, right?
contract, and it goes up X amount, and you're like, oh, 300%. But how much money did you actually make on that? And I'm not trying to, pull a cover over what people are doing. I'm just saying that's a thing. So, I like that.
I agree. I agree.
Hmm. Hmm.
So this was crazy to me when I look at lost opportunity because I was here. And some days I still go back to this place,
Hmm.
right? Because it's like, I'm like, wow, I'm capping my upside, right? Because guess what? I'm in this trade that I know it doesn't move,
Hmm.
right? That's like getting into it beyond me.
Oh yeah,
Right?
yeah, yeah,
I'm
yeah.
saying
Beyond the
people
profits.
are people. I seen a guy put $1 million in Beyond Meat. It's like that's beyond me, right? And you
Yeah,
miss these other opportunities of these quality companies going to the upside, like Disney. You're missing all these other quality companies, Johnson and Johnson. You could have put $1 million in that and made profit. So
yeah.
lost opportunity is risk look like an option. So capital was locked in on low risk reward trades. You know
Mm.
what? I'm gonna put $5,000 on this trade, and I hope it goes to the moon.
Yeah.
Okay. Doesn't make sense, right? So you're sitting out of the money lottos, right? And you're looking for it to move instead of taking that $5,000 and put it at the money contracts on a stock that actually moves on any given day.
Yeah. Yeah. Man, that's interesting. I like it. I like it.
So now guard your buying power, set a maximum capital loss. People need to understand you need to reserve some capital, right? I've been there before. It's like it's like running, right? I used to run marathons, right? When I run a 5K, they say, hey, why you go out so fast? Your first mile is 5:15. Right out and did this. This is from experience. 5:15, the first mile, I felt really good. Next mile, 5:35. Last mile, 5:50. Because
Mm.
guess what? I overexhausted myself in the first mile. And this is what happens in trading.
Yeah.
Right? I overexhaust myself into a trade. I put my whole port on the line, right? You know what? I believe in this trade. I'm gonna put my $10,000 on the line and get, oh, I'm down 25%. I'm down 50%. Instead of say, you know what? I'd rather savage 50%, invest in another quality stock that stay in the trade because it's something that's called ego, right? Lost opportunity is just what it is. You enter into a trade, you're sitting into that trade, and you think about, hey, I made $1,000 on the last time. I could have made $10,000. No, you don't think like that, right? You made your profit, you was profitable. Now you actually dial it back and get into a different trade, and then now you make another 1,000 or 2,000, and you consistently keep on rinsing and repeating that process.
And yep, and I think a lot of I did this too, and I see other people doing it, so I'm going to bring it up. Going back to the options charts, like in TradeStation, you can go to the actual option contract and look at charts on that contract, and you go, man, this thing went. I could have got this at $1.50 because it went all the way up to $38. And you're sitting there. It's the middle of the night and you're laying in the bed looking at these things going, man, I'm a bad trader because I could have bought this and that. So then the next day you try to do something crazy like that, thinking you're gonna, and it doesn't work out.
Duplicate.
Yeah. You're like sad in the even if you had good trades that day or that week or that month, you're in the bed like feeling bad that you didn't take all these crazy trades and man, I didn't make all this crazy money. Like, I don't know. I don't, yeah, I get it. I get
It
it.
happens. And
Hmm.
then we got like a few slides and we out of here, man. Let's get it. Let's get it.
Yeah, yeah, go ahead. My little
Greed
silly.
never disappears in the market. We all got some form level of greed, right? That's
Hmm.
me, that's you, that's anybody that actually
Yeah.
participated in the market.
Hmm.
But it could be managed, right? Greed can be managed with structure and habits, right? So in the market, you want to build good habits, right? You want to have good habits, right? So the goal is to turn I don't want to miss more into I want to follow my plans to win. So people say, I don't
Mm.
want to miss anymore. My whole thing, I'm tired of missing these trade setups. It's okay. Follow your plan. If the trade comes along and it matches your plan and your setup and your structure, you take it, right? It's too many times I have swung and I done lost a grand, 2 grand, 3 grand, 4 grand, 5 grand because I'm swinging, right? It's my setup, right? But guess what? I don't want to miss,
Mhm.
right? I don't want to miss, right? So my whole thing is follow the plan and you win, right? Win, lose, or draw. You have to follow your setup and your plan.
Mhm.
Right?
Mhm.
Because now if you
Mhm.
consistently keep on rinsing and repeating, you're going to get to a point where you feel more what? Comfortable. And now
Yeah.
you're compounding profits. That's what it's all about. Now you want to define, you want to build a written plan. My whole thing is you want to have a trading journal
Mhm. Mhm.
digitally or you want to have a physical. You want to
Mhm.
define your entry points, your exit points, and your risk, right? How many
Yep.
trades that you trade, you want to be able to understand it. There you go. If you're not
Mhm.
charting, how you know where you were taking wins at, right? Because you can go back year after year or month after month. Okay, I always went on Tesla in November. Why
Mhm.
is that? Look at your
Mhm.
entry, look at the charts. Now you can say, you know what, I got an idea. So now I can be realistic. All right, you want to capsize your account size, risk to reward. Maybe you want to risk 1% of your account if you have $1 million. And maybe you want to risk 10% of your account if you have $100,000. Maybe you want to risk 30% of your account if you have 10 grand. So it's all
Mhm.
about capsizing it, and then you want to reduce your stimulus on FOMO. So this is why I try to tell people limit screen watching. I'm guilty of that, right? I watch the screens, I watch charts, I got multiple computers, being online, looking to seeing how everybody else made out and P&L and things like that. Once you start minimizing that and locking in on what you got going on, you become a profitable trader, right? Success lies in you consistently keep on repeating the same process over and over and over again. Now, you want to be able to understand that when it comes with what? A drawdown. Sometimes you're not going to win much as you anticipated, but winning is still a win. Being profitable is still profitable. I would rather you compound $10 than you to lose $10. 10 plus 10 is 20, 20 plus 20 is 40. But if you
Yes.
lose 20, you don't have 20 to invest. So it's all about compounding. You want to be able to develop your trading plan, use your stop losses, practice your patience, and manage your expectations. All right. Here we go. Empowering assets to process take time. Please, ladies and gentlemen, give yourself some grace. If you don't give yourself no grace in this market, nobody else will. Remember, do not take the elevator up in options, take the stairs. Because if you take the elevator up, you're the rabbit. You're moving too fast. You're going to miss everything in the process. Be the turtle, suck everything in, learn from multiple people because everybody got beautiful strategies. Everybody trades a little bit different. Somebody might not scalp. If they swing, go learn from them. Somebody might trade strat, go learn from them. Strat soldier. Somebody might trade ICT, go learn from them. Right?
Hmm.
Somebody might just trade resistance support with no indicators. Go learn from them. And piece
Hmm.
it all together and come up with a strategy that actually fits your need. But remember, the process is going to take time, ladies and gentlemen. And I appreciate you guys from having me today, Strat Soldier. This was pretty beautiful. Hopefully, this content can help many traders moving forward in the future.
Definitely, 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 and I love it. Yeah, unshare your screens if unless you got more.
I'll show them one thing, right?
All right, go ahead.
Thing. All right, stop sharing. I'll show them one thing. All right. One thing first, right? This is a little gem. All right. I try to explain to people if you want to understand what's going on behind the scenes, I'm gonna explain to you what's going on behind the scene. The market moves in shares, not in options trading.
Mm-hmm.
Got it? So this is something that's called hedge follow, right? This is where you get the meat and potatoes, right? Now we're gonna type in Apple. AAPL. So when I'm doing my research, this is something I do. I want to see who's the largest holders of apples. I want to see who's dumping apples. I want to see who's buying apple. In this instant, Warren Buffett dropped 41 million more shares in September.
Yeah.
Y'all follow me?
Mm-hmm.
41 million shares in September. So I want to come over here and understand who's the largest holder. Vanguard got 1.4 billion shares. So I know if I'm trading option contracts, I'm trading against Vanguard and BlackRock and who? State Street.
Mm-hmm.
Because between these three, they got almost 3 billion shares.
Yeah.
Remember, shares, 100 shares goes into one option contract. So remember, we're trading against hedge funds and institutions. These are who we're trading against. So as a trader, we're not trading against each other, ladies and gentlemen. There's enough money for all of us out there in the market. So this is how I look at it. Warren Buffett is dumping shares. BlackRock, pretty much less activities. You want to see who's moving, who's buying what. Now, another thing that I look at, right? I want to see what is Vanguard been buying and what has Vanguard been dumping. So I come here and look at Vanguard. They got $6.68 trillion in equities. This is not including other form of investments like real estate. So they got $6.68 million in equity. So they pretty much own pretty much a piece of every company that's public, right? That's
Mm-hmm.
volume and that means something. I go down. I understand that they own 2.2 billion shares of Nvidia, right? And they bought Nvidia at $13.06, an average price,
Yeah. Mm-hmm.
right? You're like, wow, that's something. No, but what if I told you if you clicked on Nvidia, it's somebody that outdid Vanguard, and who do you guys think that is? So this is how I follow the money trail. Guess what? I'm starting to understand that. Guess what? FMCR. Anybody know who that is? That's Fidelity.
Oh,
Fidelity bought 982 million shares at $4.60
on average, yeah.
on
Yeah.
average. So they up 3,800% on this trade alone.
Man.
So this is the things that I follow, right? Now, I
Okay.
say, you know what? I want to see what BlackRock has been buying lately, and then I want to go chart it. Right. So I say, you know what BlackRock has been buying, latest trade, what they sell, HES. So that's an antenna. If BlackRock sold 100% of their portfolio on HES, right? I go to the charts. HES. All right. Go to the charts and I want to look. I'm like, did BlackRock sell 3 month time frame? I want to look at it, looking at my chart. Yes, fell two up, right? Failed to continue the trend. We started dumping at 42.30 now. We came all the way down to what? $30. A $12 drop. Because guess what? BlackRock sold off on the what?
Yeah.
The shares.
Yeah.
That's just that simple. Now, I want to see what BlackRock has been buying, right? I'm like, wow, what BlackRock has been buying, right? I want to say, wow, why did they buy APP in September? So I go look at the chart. So this is basically looking at APP in September, right? So I can put this on a quarterly time frame. This is April. This is July. This is what? October. So I got to put it on a monthly time frame to see when did they buy in. They bought in September at 454, and we went all the way up to what? 744.
Wow.
Major
Yeah.
return. So using fundamentals helps you as a trader,
Hmm.
seeing who's buying and who's selling. Now, I cross-referencing this. Guess what else? All right, let's get it. GEX. So I go look, APP, and I want to see where the money is at, right? So if I'm trading options, I'm looking at APE. This week, 690, we got 9.8 million. 700 strike price, we got 9 point what? 6 million.
Hmm.
I'm
Hmm.
seeing where the money is at. And now if I'm trading options, I understand this contract makes more sense. This contract makes more sense. And then I go back to the charts. What's happening? Daily time frame, we completely exploded
Yeah.
because it showed me what the money was already. This is just simple. I do it all day. That's
Man.
all.
Yeah, I can see you're going through it. You're pretty.
It's simple. It's pretty easy, and it's like forward looking. I'm able to actually analyze that, look at those, and then store it in other different variation and see what's going on in the market. Being able to rinse and repeat, right?
All right.
Rinse and repeat. So that's what
Man,
it's about, man.
I
Appreciate you
love
having
it.
me
This is
today.
fantastic. This is fantastic. Yeah, give me share your screen so I can see big face, big screen, big all our faces together. Because I want definitely want people to see you. Um, I really do appreciate that. I try and put my little quips in there, my little silly jokes and things like that. But you definitely brought the heat today, and definitely a lot of knowledge, cross-referencing things. And all right, I promise I'm gonna start looking more at the fundamentals of stuff.
I've
I
been telling you
promise.
for a while, man. It's because remember, a counterstick is not going to move without the news. So
Hmm.
I don't care how many threes you got. I don't care how many twos you got, or one you got. A news creates that.
Hmm. Hmm.
People like, I got to fail two down, right? So this is something I want you to go back test. Go look at the last 4, 8, 12, 16 earnings. Uh Johnson and Johnson, CVS, Coca-Cola, Pepsi, McDonald's, AMC, what's the next one? Kroger's and Mondelez.
Okay.
Look at them on a weekly time frame, all right, and pay close attention to what happens 4 weeks, 2 weeks before earnings.
All right.
You
All right.
start realizing something, right? They usually have good or positive news weeks before earnings that drive the stock up and drive it down. And we
Mm.
usually come back and fill the gap either way.
Huh.
So they actually giving you clues weeks before the earnings come out, but we just not paying close attention to it because it's not on our what? Our radar.
Radar. Yeah.
There you go. So
Man, all right. Next time you send me some crazy stuff, I'm what? All right, I'm gonna
yeah,
pay attention.
I sent you
I'm
that
gonna
one.
pay attention.
I sent you that one thing you said is a penny stock, right? But I'm like, if Bitcoin rises, right? Where do you think that stock is gonna go to?
Yeah, what was that stock? One more time. What was it? What was it?
Let me see. I sent you a few of them. Let me check.
Yeah, he did.
Let's get it. I sent it to you. I was like, man, I hope he take advantage of it. I just looked at it earlier. Yeah, you probably got to go on your phone to find BTC or something like that. Let me see.
Yeah. Let me see. You said, let me see. You
I can
do.
give you
Yeah.
I can give you one. Type in NNOX.
NNOX. Okay.
All right. So this Nano X, right?
Mm-hmm.
All right. And if you look and see who's invested in them, hold on.
Yeah. Let me see if I got some insider. I got some insider traders here. Okay. All right. I got one guy named Randall who bought $3,000 worth of this thing.
State Street, BlackRock, invested in it, Kathy Woods, Vanguard, Goldman
Okay.
Sachs, Nvidia, because
Huh.
they need Nvidia what? Chips. This is the new
Oh.
X-ray machine as we move forward, right? You know, not even gonna need any text. Is a machine. It just takes phenomenal X-rays, is able to diagnose cancer years ahead of time. This is the wave. This is the future.
Oh, okay. This is that little
X-ray
machine you're talking
equipment and
about.
machines, right? You might
Hmm.
not see it now. Citadel just bought in, Ken Griffin just bought 78,000 shares. Kathy Wood just bought 69,000 more shares
of this.
of this.
Huh.
All right. So I'm
Let
trying
me
to
do
give
this.
you ahead
Hold
of time.
on. Hold on. We're going back to the charts. We was about to end this show, but we going back to the charts. Look at this thing. All right. We're looking at it now. NNOX used to be somebody. Used
Put
to
it on
be
the 3 month.
somebody. Uh, let me see here. I got the yeah, we're going to the quarter. Let's go to the quarterly. That does. So
52M.
2021, $95.
Right. Look
Now,
at the spike 2023 when they found out that
right here.
Nvidia invested in it.
Okay. 23
Right.
bucks.
That's our resistance. So right now it's $3.83 a share. And we got to
Mm-hmm.
fail two down on a quarterly.
Mm-hmm. Ah, I see what you're saying. Took out the lows, and then we take out if we go scenario
570
three.
is a wrap.
Okay.
So having 1,000 shares at $3.83 and we go back to $20 and then we accelerate over the next couple of years back to all-time high, which we would pretty much get there over the next 60 months, probably 72 months. Because
It's
if you look at the innovation of this company, there's like no other.
it's calculator time. It's calculator time. Let's see. Sometimes we do a calculator time on the weekend shift. It's calculator time. You're saying okay. So, uh, when are we gonna get in? We're gonna get in. We're getting in now, or
Yeah,
what?
now, tomorrow.
Okay, so 383, and this is for funsies. All right, so people out there, they'll be like, okay, you're saying 1,000 shares
1,000 shares.
times 1,000. All right, that cost me $3,000, Cardave, almost 4,000. All right,
Let's say we go back to 2023 high,
all right, back to
7.
2270. All right, so 2270 take away
3
$3.83.
times
That's
1,000.
All right, that's $18 profit if I just buy one. For the small count trader, if you
Right.
just buy one.
There you go. Now times that times 1,000, you just made almost $19,000.
Man,
And if you just go look at
man.
the specs in the company, just let it
Yeah,
sit. It is a bona fide hit. BlackRock, Vanguard, State Street, Citadel, they're not buying just to be buying.
I agree with that. I agree with that. Okay.
It's a whole. It's like if you go look at like Songhorn, I told people to get in that around $1, $2,
Mm-hmm.
right?
Mm-hmm.
Or BBAI, $1, $2 and some change, right? So it's like you have to be willing to get these and just sit, because penny stocks, Apple was once a penny stock.
Mm-hmm. Yeah, that's true.
Microsoft was once a penny. You get what I'm saying?
Yeah,
All these,
Tesla was.
all
Tesla
right.
was as
So it's
well.
like
Hmm.
you're not looking for the next Apple. You're not looking for the next Microsoft or Google and Nvidia. You're just looking for the next quality company.
Man. Okay, let's
This
say,
is one of them.
man. And I say all the time, I'm like, when I see things like this, usually when I do calculator time, I say, stop talking to me about options. Stop talking to me about options. Just buy the shares. And that's when I usually do calculator time. But yeah, I get it. That makes sense. That makes sense. Quality company, looking at fundamentals. And
Look at it on a weekly. Even though we went up here, we got an uptrend reversal, right? But I
Mhm.
told people to get in before earnings. It was $2.78. You still are being profitable $1 a share. And when
Yeah,
earnings came around, it went up to 471.
man. All right, right here. I like this one. $5 right here, February 15th,
And
right
we
here.
exploded.
Bam. Golly, from $5.89. All right, not a penny stock, all the way up to 14 bucks. Man. Yeah, that's the kind of move. That's what I'm talking about. We like those long red and green
It's
bars.
gonna happen. It's destined for it. It's
Hmm.
coming. It's coming.
I don't know if I'm gonna go 1,000 shares, but I'll go some. I'll go some. I don't know about 1,000. I
Yeah.
really would love this thing to be above $5.
Yeah. But why not ride it up to 5?
Mm-hmm. Mm-hmm.
Get 100, put $383 in there. If it go up to 5, and you say, "Wow," and then it go up to 7, you said, "Wow." Your only problem is going to be why I didn't buy more.
We
It's just
got
the picture.
we got rules here, Cardave. You're breaking the rules. You're making us question our rules.
Well, when it's a quality company, I'm thinking about forward looking. I'm thinking about the profit.
And that's what I'm trying to emphasize by looking at this.
And
And
it's healthcare. We
mhm.
understand as we move forward into the future, everything is going to be futuristic. And this is the way it works. I want you to pull it up, or I can pull it up and just show you the machines and what they have.
Okay, okay. Yeah, I'll stop this one. I'll let you do it.
Yeah, so people can see it, man. It's like I think people need to see it to believe it. All right.
All right, we'll wrap it up on this one. We'll wrap it up
Oh,
on
now
this
no,
one.
this is what it's about. So the difference between X-ray machines and this new X-ray machine, old X-ray machines do not use cold anodes, right? This machines use cold anode, so it's gonna take it's gonna last a long period of time. So over a long period of time, it's gonna take less time for it to actually what go bad, right? So they don't have to consistently keep on replacing it. So what they do is they got a nano table. This is the new X-ray machine. They put you on it. It scans you back and forth, internal everything that you need to going on. So guess what? It's going to pretty much replace doctor. And guess what it uses? It's use AI,
Hmm.
Wi-Fi signal, bone scanner, liver solution, cardiac. So dealing with anything with the heart. So all of this is going to be fabulous as we move forward. So nano source, AI source. So this is the future. So you guys can go look it up and you can see what they bring it to the table. They already using in multiple hospitals around the world. Oxford is using it, and then so on from that. So this is what it's about. Lock in on this. All right.
Yeah, yeah. If it's being actually being used, that's definitely something I'm looking at. I like that. I like that. We'll put it in
Yes, man.
usual suspects. We're gonna stick it in usual suspects, and we're gonna look at it
I
because
appreciate you, man. Try to enjoy your night with your family, and then we'll get back at it.
all right, don't go away. Don't go away. But for everybody else, thank you so much for being in here. I know this was a longer one, but I know you learned something. For those people that do trade options, I know, especially with those other Greeks that most, people don't necessarily track. And then I know Cardave said something that got you taking notes. Money, I had a mentor tell me a long time ago, note takers are money makers. So if you watch this whole thing and you're like, what did he say? Go back and watch it. All right, I'd rather you go back, watch the same thing over and over. This was a long one. So what I'm saying is, this was worth watching over and over. All right, it really is. This is a good one. And man, stretch are going to be trading stocks, trading options and trading penny stocks. You messing up my whole groove there over
I
here,
got you.
Carday.
Well, you come live. You say you're gonna come live trade with me, so we'll get you in good
We're
spirit.
gonna. I'm gonna have to. I'm gonna be trading 30-second charts and all kind of crazy stuff. I'm gonna put some NOS tanks on my tank. That's what it is. We're gonna have some jet fuel on my tank. I really do appreciate this, and everybody go check out one more time. Where can we find you? One more
Empowerment
time.
and Access on all platforms: YouTube, X, Instagram, all of these platforms. Make sure you hit the like button, subscribe. Make sure you guys turn on the notification. Let's continue to keep on building a positive communities. Remember, ladies and gentlemen, there's enough money in the market for all of us option trade. Let's stick together. Let's continue to keep on growing. Your community, my community, everybody community. Let's get it.
I love it. I love it. Fantastic. Don't go nowhere. And for everybody else, I'll talk to you guys later. Peace.
Peace.
Man, that was a good episode with Cardave. Thank you so much for being here, Cardave, and teaching us how to trade options. I mean, the Greeks, and then two Greeks I didn't even know were a charm and was it Vanna? Man, I'm going to be looking for those. Very good stuff. Learned a lot. So, I know Cardave was a lot more serious than I am about talking about this stuff too. So I hope I didn't distract you guys with my little jokes and laughing. You know how I do. I always like to laugh and keep the energy up. So hopefully I didn't distract you too much with that. I thought it was a really good episode, real good, lots of information. If you want daily updates of the weekend shift, all right. Because I do the weekend shift on Saturdays, and then through the week I update what's in force on the week, and then what actionable signals are for the next day from the weekend shift watch list. All right, so you're not by yourself and trying to come up with what plays are we looking for next. You're not by yourself in that. Go to the membership section of this YouTube channel. You got two choices. All right, when you go to the membership section, there's two choices. You got Weekend Shift Crew, and you have Strat Warriors. All right, Weekend Shift Crew gets daily videos where I go through the what's in force, what happened in the broader averages, what's in force on the week, and then I help you create a daily watch list for the next day. And then yes, I add to the watch list as I see things in force. And then also with the Strat Warriors, all right, you get the daily videos, and then you also get coaching sessions on Saturdays, 1 hour before the weekend shift. All right, and I also do a macro vid for you guys as well. And then both, all right, get over 100 plus videos, old episodes of the weekend shift. And then you have all the old videos of my daily watch lists, my daily videos, and macro vids too, so you can see how how things have been going, So you got a lot of content to watch, lots of stuff for you to learn. All right, lots of stuff for you to learn. So go check that out. Again, Weekend Shift Crew or the Strat Warriors in the membership section of this YouTube channel. And again, of course, always you can go to thestratsoldier.com. If you don't know anything about trading, check out my Strat starter kit, the Strat starter kit. You get two ebooks, Hammer in Force and 0-2 Trading. And then you also get one of these coffee mugs, all right? So you can sit at home and then laugh with me on Saturdays, drinking your coffee, looking at the charts, wondering how we can get in on this stuff, okay? And then while you're there, check out my courses, the execution course, the Strat trade checklist, the Strat, the time frame continuity course. It used to be called the Strat trade checklist course, the time frame continuity course, and then unlocking broadening formations. And if you want all that at once, check out Combat Load. I'll be doing a webinar next week, so next Wednesday, so I'll be getting that up on the site too. Thank you again for being here. This is so much fun. Hope you learned a lot. I'll talk to you guys later. Peace.